Okay, good morning and welcome to the December 2025 UCLA Anderson Forecast Conference. We're really pleased to have this conference. We're going to talk about lots of aspects of finance, which is very much in the news today. We have a great program for you. On kind of a personal note, a number of you who were here a while ago saw that I announced my retirement. And you're probably saying, what is he doing here now? I thought he retired. Well, that didn't last very long, as things go. So I am now officially back with UCLA in a slightly different capacity. I'm supporting our new forecast director, Sebastian Edwards, still leading the California forecast and working with William Yu on the U.S.-China Economic Relations Report and other things here for UCLA. So I'm once again employed by UCLA. Short retirement, didn't work so well being in retirement, but that 30 days was, I got everything that I could think of to do in retirement and done in 30 days. So I'm back at work. And be happy to be back here. We have a great program. We're going to start out with Clement Boer, who leads our U.S. forecast team, who's going to talk about the U.S. economic outlook. I'm going to talk about the California economic outlook. And then we have a special presentation by Ryan Cummings. And Ryan is Chief of Staff of the Stanford Institute for Economic Policy Making. And he's been there since October 2023. From 2023 to 2025, Ryan served as an economic advisor at MIT's Center for Energy and Environmental Policy Research. And prior to that, he was staff economist at the White House Council of Economic Advisors and much more. So please read his bio. Ryan's got a really interesting talk. We'll have a little time, not much, but a little time for Q&A. Take a break. And then we have a really interesting expert panel, incredible experts on this panel on stablecoins. And then we're going to have a keynote address, which is going to be a conversation in which we're going to talk about private equity. So lots of different aspects of finance, which is really so important today. And so before we get going, what I'd like to do is thank our sponsors. We are a public institution. We could not put on these programs but for the generosity and support of our sponsors, and they deserve lots of recognition. And our principal level sponsors this day is RSM and Yamava Resort and Casino at San Manuel. At the platinum level, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and University Credit Union. At the gold level, Alaska Airlines, Bank of California, California Steel Industries, Hub International, Leap Development, Neumo, PNC Bank, Robert Half, SMBC Manu Bank. At the silver level, Marsh McLellan Agency, Salom, U.S. Bank Private Wealth Management, and Wilmington Trust. And at the bronze level, Accutive Security, Hanmi Bank, HDR, the Port of Long Beach, and JP Morgan. Many thanks to them. As I say, we couldn't put these on without their support. And just a note that if you did not hear your company's name, let us know. We can fix that. So, we, again, are grateful for your support. So a lot's going on in the economy, a lot's going on that we don't know in the economy because of the shutdown. And let's turn to the U.S. outlook. So, Clement, what's happening in the U.S.?
All right, thank you, Jerry, and good morning, everyone. So, as this title suggests, in the crosswinds of AI and tariffs, what I'll be talking with you today is mainly about AI and tariffs. And so if you were here last quarter, you'll probably remember this cartoon that I showed you back then, where I argued that despite all the different events and themes of 2025, from stablecoins, which we'll have a great panel on later, to the Doge cuts, What has really had a big effect for the US aggregate economy that have been most important is AI, which you see here pumping a lot of new hot air, really driving the US economy, while tariffs are trying to poke holes in it and deflate it. And this has led to a lot of interesting dynamics in terms of the aggregate measures and statistics. You have an unemployment rising, you have inflation rising, but you also have strong GDP growth. And so how do you make sense of this? And how, as your central bank and the Federal Reserve, which I'm showing you in the back, do you adjust the economy and interest rates to accommodate this economy with these different forces pushing it in such different directions? And so, do they want to lower or sink or raise the temperature in the room to support the economy? Now, I want to adjust this figure a little bit from what's happened in the fall, which is that, well, what if you have a government which decides to shut down and turn off the lights, thereby leaving the Federal Reserve in the dark in terms of economic data about where the economy is going? So this only adds to the difficulty, not just in terms of setting interest rates, but also adds to the difficulty as economic forecasters in terms of gauging and predicting where the economy is going to go going forward when we don't have data from the last couple of months. And so you'll see that throughout my talk that, we don't have data often going past September or even August in some cases. And you'll also see it in Jerry's talk later when it comes to the California economy. So starting with tariffs, which was one of the two main themes I mentioned, there's been a lot of discussions about, well, the tariffs haven't seemed to have had as large an effect as what was expected earlier on in this year. And there's very good reasons for that. And that's what I'm showing you here in the left graph where I'm showing you the effective tariff rate back from 1930 up until today. And what you see is that, first of all, we had the Smoot-Hawley tariffs back in the 1930s, which were very large and contributed to the Great Depression. But then going up to today in 2025, I'm showing you in light blue the statutory tariff rate that was in April, right after Liberation Day. And then I'm showing you what the statutory tariff rate is today. And the point is that tariffs are actually much lower than what was announced back then. Thereby, you are obviously going to have a much smaller impact from that. Now, it actually gets even smaller than that, because when you measure the realized tariff rate, that is how much revenue the government is actually taking in from tariffs as a percentage of imports, the realized tariff rate is even lower, only around 11%. Now, how can that be? Well, companies have done a very good job of evading paying these tariffs in many ways. And I don't mean that in an illicit or illegal way, although there might be some tax evasion going on the margin. There are legal ways you can do this. For instance, one you've probably heard of: if you import all your goods and accumulate your inventories before the tariffs go into effect, then you don't have to pay these tariffs right now, right? So you should imagine this rate is going to go up, but you shouldn't expect it to go all the way up, because there's also other things that have changed, such as if you look at the goods that are coming in from Canada that were USMCA compliant back in 2024, and that means that they're duty-free, that was at 38% of those imports. Now the share of imports from Canada that are USMCA compliant is 81%, right? And it's not because that actually there's the amount that are now USMCA compliant versus last year has doubled. They were USMCA compliant back then. The companies just didn't certify and go through the paperwork and the expenses of achieving that compliance, because it wasn't worth the cost, because back then there weren't high tariffs to pay anyways. Right? And so that's another reason why you see that these statutory rates are still much higher than what the effective rates are. And if you want to look at it from a consumer perspective, what is the price impact of these tariffs? Another thing that's very different from the past is that a lot of the cost of these tariffs haven't been passed on to consumers. Now, it's very hard to get a good estimate of how much of this pass-through has happened. And the best estimates we have vary from around 20% pass-through to consumers up to 55%. So you see there's a wide range there, but it's much less than the usual 100% or close to 100%, which is usually passed through. And so that's why, at least until now, you've still seen a smaller effect on prices than what we would have expected at the beginning of this year. That's not to say that there hasn't been any effect. And so that's what I'm showing you here, showing you the inflation rate for a headline CPI over the last couple of years. And I'm also showing you the contributions from services inflation and goods inflation to that headline CPI rate. And what you see in 2025 is this growing yellow wedge, which is the contribution from goods inflation to headline inflation rates, right? That is the tariffs feeding into the goods, raising the prices of goods and boosting inflation. And the best estimates we have of how much that has contributed to headline inflation right now comes from the Harvard Pricing Lab, and they've estimated that about The actual headline inflation rate is 0.7 percentage points higher than it would have been if we didn't have these tariffs in effect. But I also want you to point out the blue in this, which is services inflation, right? And what you see is that that's still elevated relative to before the pandemic. Services inflation is still higher, although it's trending down. But the trending down actually doesn't reflect current cooling in inflation services right now. If you want to further split up the services inflation, you can split it up into core services such as health insurance, education, car insurance, and the likes, haircuts, restaurants. And you can split it into the cost of housing, how much does it cost to rent your apartment, for instance, right? And that measure, the cost of housing measure in the inflation component, is the average cost across all households, even those who signed a lease 2 or 3 or 4 years back that haven't had their rents up since then. It's not the current market rate. And that current market rate actually cooled back in 2023, which means that that average across all households is still catching up and falling to that previous cooling that happened, right? And the other component I mentioned, which is just core services inflation outside of housing, that's been horizontal this year. It's been flat. It's stopped declining since earlier this year. And so we're also waiting to see more cooling there, but it hasn't happened yet. And so that's another reason why you see this blue component still being elevated. Another way that tariffs have had an effect, albeit probably more indirect because a lot of it comes through the tariff uncertainty, which makes it very hard for firms to plan for the future and make hiring and investment decisions, is that because it has dampened those hiring decisions, it has cooled the demand for labor and hiring in the US economy. Now, the Federal Reserve Chair, Jerome Powell, calls this a curious kind of balance because at the same time, labor supply has also been cooling. That comes in part from the growing number of baby boomers that are retiring, or not retiring, as in front of Jerry, but the majority of it comes from the restrictive immigration policies as of this year, which has really cut down on the amount of immigrants we're getting into this country. And so to give you an example here, over the last 3 months, average payroll employment growth has grown by 62,000 a month on average. That's, if you go back 10 years, look from 2010 to 2020, that's usually around 150,000 to 200,000 a year. So this is a very small number to what we're used to. And there's been many months over the summer where we even had negative payroll growth or just near zero. So much slower job growth than what we're used to in this economy. And I would go as far to say that this isn't really a balance, because this balance is not really holding, and it's been gradually deteriorating throughout this year. And you can see that because unemployment has been slowly rising, and as of September, it was at 4.4%, right? So this means that labor demand has been cooling faster than labor supply. And importantly, the rise to 4.4% is an important inflection point because it means now that we're in a state of the economy where we have fewer job openings than we have people looking for work, that is job seekers. And why is that important? And that's what I want to show you in this picture by plotting the Beveridge curve with historical data going all the way back to 1910. This Beveridge curve does shift in and out, so I've adjusted the data to always intersect with the current full employment rate. Don't worry about that. What I want you to show is that we're usually on this curve. And if you go back to 2022, we're very high up it, which means we're in a state where there's a lot of job openings, a lot of companies trying to hire, and very few unemployed, very few people trying to hire them, right? That is a recipe for high wages, higher wage inflation, and higher inflation. That's the situation we were in back in 2022 with a very hot job market, right? And so when you cool that job market off from being hot, all firms have to do is hire less people and show less job postings, which means that you get a fall in the job openings, but not much of a rise in unemployment. Now, the point we're at right now, pivoting from where we have more job seekers than job openings, means that further labor market cooling cannot just result in fewer openings, it actually has to result into more layoffs. So if you see much more job cooling, it's going to translate into firms actually needing to fire people, not just stop hiring them. And so that's why we're at an important inflection point and why you've heard the Federal Reserve be extra, concerned about the labor market going into this fall. And so that takes me to the Federal Reserve because they are really in a lose-lose situation right now, right? So if you want to game out and think about what they're going to do going forward, suppose they decide to cut interest rates And inflation in a year's time becomes entrenched. Inflation expectations stay high because they haven't cooled the economy significantly and there is this extra demand going on, right? Then they haven't fulfilled their price mandate, they lost. So suppose instead that they decided to hold rates high, right? And maybe inflation comes down, but we have a recession. They lose, right? They're going to be blamed for that recession. And on the political side, even though they try to, keep out the noise from the political pressure that's coming from the administration, it must weigh on them to some degree, right? You cannot tune that out completely. And they are being set up to being blamed for any recession that would happen if we do end up having a recession. And so you would have to worry that that is influencing their decisions. And so we've come up with a nice way to show what the Federal Reserve is doing in terms of setting monetary policy and whether that monetary policy is focusing more on the labor market or focusing more on inflation. And that's what I'm showing you here, where I've used the concept of the Taylor rule, which is a nice prescription for what, a simple prescription, but a nice prescription for what interest rates should be, considering what unemployment is and what inflation is. You see this gray area in the middle? That's because there's a lot of uncertainty about what the neutral rate of interest is. The neutral rate is where you're not adding to this and stimulating the economy, and also where you're not contracting or pushing against the economy's growth, right? There's a lot of uncertainty about that, so there's a lot of uncertainty about what the optimal neutral rate is. But then what I'm also showing you here in yellow and blue is weights where if suppose the central bank or the Federal Reserve cared more about inflation, then they're known as an inflation hawk, and they would put more weight on rising inflation and therefore want to set a higher interest rates. And that's what you see in yellow. And then you also have monetary doves, which is central bankers that care more about unemployment and rising unemployment, and would want to lower rates more and not care as much about the rising inflation. That's what you see in blue. And though we don't have data over the last couple of months, as you can see, for inflation and unemployment, we do have data for the interest rates. And if you project the blue and the yellow areas forward, you can see that, well, right now, interest rates are certainly in the dovish blue area, right? Which means that the Federal Reserve is putting more weight on their employment mandate relative to their price mandate, right? That's not to say that it's wrong. There are reasons sometimes, as I mentioned in the past diagram, where it might be correct to focus more on employment than on inflation. All we're showing here is that trying to analyze and understand what they are doing and what they are focusing their attention on. The other thing I do want to mention, which is a bit more positive, is investment in AI this year and how it's really adding extra stimulus to the U.S. economy, which is otherwise, being facing downward pressure from the tariff and immigration policies that we've had. And so here I'm showing you total fixed investment growth going back to 2022 with the three components that make it up. That is residential investment in gray, traditional business investment outside of high tech in blue, and then you have the high tech investment mostly related to AI and data centers and microchips and the likes in yellow. And what you see in 2022 and 2023 when interest rates were going up was that residential investment really crashed. It really contracted a lot. And since then, residential investment has really been frozen and paralyzed at a very low level. Now, fortunately, going up into 2023, we had sort of to make up for that a lot of traditional business investment that came out in part from the previous administration's reindustrialization policies. We had the CHIPS Act, we had the Bipartisan Infrastructure Act, we had the Inflation Reduction Act, and those boosted and gave a lot of incentives to invest in the US in a more traditional fashion. But if you look at 2025, both of these more traditional sectors are actually contracting and starting to contract more, and that is a concern. And there's good reason to believe that a lot of this comes from the higher costs of capital related to tariffs and the investments, because a lot of that equipment is imported for that. But as I mentioned, fortunately, instead, we have a lot of investment from AI, which means that total fixed investment is still positive and it's growing and going upwards in its current trajectory. Right? And there's another way that AI is also boosting current growth, and that is through consumption. Over the last year, the stock market has added about $5 trillion in value. And even if you just have a small wealth effect, and by wealth effect, I mean that when you are richer, when you feel richer, you spend more money, right? So even just a small wealth effect on $5 trillion leads to almost $200 billion in increased consumption expenditures by households. And that means that over the last year, we've had about 1% higher increase in GDP just coming from consumption growth based on people feeling good about their financial wealth, right? And so I'm sure Ryan is going to talk a lot more about that in terms of AI and its implications for the economy in his talk. So let's turn to the outlook in the last 5 minutes I have. We do expect unemployment to continue to rise modestly, but I really want to emphasize modestly, as we are at an unemployment rate of 4.4% right now. And so we expect that to rise to 4.5%, just above 4.5% at the end of this year and going into the beginning of next year. And this is mainly due to the current, what I've discussed in terms of tariff and immigration policies. Jerry's going to talk a lot more about immigration, so if you're disappointed that I haven't had time to cover that here, he will cover that a lot more, especially because it has a much more relevance for California than the national economy. And then, as I mentioned, going against this, we fortunately do have this stimulus coming from artificial intelligence investments. And we do expect in 2026 and 2027 that these artificial investment is going to have the upper hand and going to lead to actually downward pressure on unemployment and a recovering economy, also because of lower interest rates. And the fiscal stimulus is going to come from the One Big Beautiful Bill Act. You're going to have larger deductions on Social Security, no tax on tips and the likes. It's going to add extra fuel to the U.S. economy and lead to somewhat of a recovery relative to where we are going into next year. Turning to inflation, no surprise here, we do expect inflation also to continue to rise moderately, going up to 3.5% towards the early part of next year. As I mentioned earlier, the pass-through from prices, from tariffs into consumer prices is somewhere between 20% to 50%. And that is expected, of course, there's a lot of uncertainty, but that is expected to rise up, maybe not to 100%, but at least to 60, 70, 80%. And so we can think that we're sort of about halfway through the pass-through of tariffs into prices. And since we've had about 0.5 percentage point increase in prices from tariffs already, you should expect at least another 0.5 percentage point of increase in prices due to the tariffs going forward over the next quarter or two. But going forward after that, after tariffs have been pushed through and inflation starts coming down again towards the end of 2026, if you notice, we don't expect inflation to go all the way back to 2%, right? Where we are right now is about 5 years after inflation initially went above its target. So we're 5 years out from being away from our inflation target. That is 2%. Now inflation is going in the wrong direction. And we are shifting to easy monetary conditions. As I showed you, that interest rates and what the Federal Reserve is doing is focusing much more on the labor market. That is a recipe for not bringing inflation down to target. And so, if inflation really does get unanchored, this could become higher. If we get a more significant weakening in the labor market, this could go lower. But as of right now, there is good reason to believe that you should not expect inflation to come rapidly down to 2% after next year. Turning to interest rates, we do expect, as I mentioned, interest rates to continue falling, although there is a lot of uncertainty about the pace of what that's going to happen. About a month ago, it looked unlikely that they were going to cut, or perhaps a coin flip that they were going to cut going into next week, but now it's looking more likely that they probably will cut. But there's a lot of debate and disagreement even in the Federal Reserve on the FOMC committee about where interest rates should be set and where they should go, right? And that makes a lot of sense because it's a very tough time right now to figure out what is the right way for them to go with unemployment and inflation both going up. You can make good arguments for both lowering interest rates, for both keeping interest rates steady, or even raising them. Right? But as of right now, it's looking like we are on a current trajectory for at least lowering them through the beginning of next year. Although we think they're going to go at a more gradual pace than what we've seen so far this fall, with perhaps a cut every other meeting or so instead. Now, there isn't as good news in terms of lowering interest rates on the long end, and that's because a lot of these cuts in the short-term interest rate are already priced into the long-term interest rate. And so there isn't much more space for that to fall unless we get a recession or something, and suddenly we think the short-term rates are going to go even lower, say to 2, 1, or 0%, right? And on the other side, there's a lot of forces moving long-term interest rates upwards. We have an aging population, which means there's more costly social services and fewer tax receipts to fund those social services. And that's on top of an already very large U.S. government primary deficit, right? We are nowhere near steering a neutral fiscal ship in this case. And finally, we also have already a large U.S. government debt of about 100% of GDP. So even just servicing the cost of that debt is very expensive and goes right now at around 3% of GDP a year just to pay off the interest expenses on that US debt. And that's only going to go higher with interest rates being closer to 4% than 3%. Over the next 2 years, about a quarter worth of GDP that we have in debt needs to be refinance at the much higher interest rates that are today relative to what they were initially taken out for before the pandemic. Those 2-3% interest rates we really had back then, even 1% interest rates. And so that's going to lead to further, a rising US government debt and further upward pressure on long-term interest rates going forward. And lastly, as I mentioned, so there's one thing I want to point out about this figure in terms of GDP growth, which you may find a bit odd, which is that we have a yellow bar before the forecast horizon, right? And so that's, again, the fact that we have missing government data from this past couple months, which means we don't have the official GDP statistics for the third quarter of 2025, right? And so we had to do our best to make an estimate of what that was, and it's looking like it was a very strong quarter of GDP growth based on the monthly data that we have from consumer expenditures and the likes. And so that is great news, and we do have more good news going forward in 2026 with this investment-driven AI-driven growth. But we do have this one quarter in 2025 Q4, you see, where we're not expecting very high growth. That comes from the government shutdown. And so the estimates, again, vary, but the government shutdown, which was the longest in history of 43 months, and it was a full government shutdown, not just a partial one, that's going to shave about 0.5% to 1% off of GDP growth in the fourth quarter of 2025, and will likely make that up in the first quarter of 2026. So to end off, I want to just mention the risks to the forecast, which are, as always, large, and especially for this year, larger than usual. There is a lot of uncertainty regarding these deportation and tariff policies. The Supreme Court is going to rule on some of these tariffs over here in December, most likely. Although the administration has other policies they can use to enforce tariffs if they were overruled. The deportation policy, it's still very unclear where that's going to go, how much is going to be ramped up, how much of an effect it's going to have on the U.S. aggregate economy, although we're already seeing modest signs on the California side, which you'll see in a second. And then there's another Supreme Court ruling coming out probably in January, February, regarding the Federal Reserve independence, where the governor of the Federal Reserve, Lisa Cook, was tried to be fired. And if that is held up, that the administration is allowed to fire her, that means that administration is likely going to be able to have a lot more influence on interest rate setting going forward. And so that's another uncertainty to be aware of. And then lastly, I'm not going to mention anything about the artificial intelligence bubble, or even if there is a bubble, because we have a whole speaker on that coming next. Okay, so thank you.
Thank you, Clement. And now we're going to turn to California. There we go. And so the beginning of Clement's talk, he was talking about kind of the lights going down, and that was the image. I wanted to make the image kind of a little more California-centric, but the same message. But this is the image I want to leave you with. I called this presentation a dead reckoning forecast, and the picture you see there is of the Winfield Scott. So in the 19th century, we didn't have the 5. We didn't have good roads going north and south. And the way in which goods and people were transported was by schooner up and down the coast. And as you're going up and down the coast, if you can see land, it's pretty easy to navigate. But we all know about the marine layer in California coastal fog. And when you're in that, what do? Well, the way in which they navigated, because they didn't have GPS devices, was they knew where they were, or thought they did. They knew the direction they were going and the speed, and they could plot out where they were going to end up sailing during that day. Right? And that's called a dead reckoning navigation. That's kind of where we're at today. We knew in August, or thought we did, and we have an idea of the speed and direction from the limited data that we have, so the non-federal data that we have, and I'm going to show you that. And so that's how we kind of build our forecast. Okay? So that's the dead reckoning forecast. I'll talk more about that as we go along. And so I want to first talk about deportations and unemployment, and then go to the sectors that are important for California's growth, So think about manufacturing, construction, tech, and the like, and then we'll go to the forecast. So let's start with what do we know, what did we know of where we were? So this is kind of that fixed point that starts the dead reckoning forecast. This is employment growth in jobs for the 12 months ending August 2025. That's the last data we have. If you look on the left-hand side, it is healthcare and social services, education, state and local government, and farm. And when you think about that, none of those really have legs. And on the right-hand side are those sectors that we need to grow fast to grow California's economy: durable goods manufacturing, logistics, tech, and the like. But what I want to do is talk about immigration policy now. And so if we annotate this with capital I's to the sectors where immigration policy is going to be sort of most pronounced. And so we start, with healthcare and social services, and education is in here. Education's there because, as we know, California school enrollment has been going down. The speed at which it's going down has just increased with deportations. And then we just continue with these eyes going all the way across, and you see that there are a lot of sectors that are really impacted. So what I want to do is talk about, kind of what we know about deportations and their effect on the economy. So first, this is being rolled out, this deportation policy is being rolled out much slower than we expected. And there are kind of three reasons. One is logistics. The pipeline just wasn't large enough. It was not a large enough gauge to do what the administration anticipated doing in 2025. They're investing in that and increasing the pipeline, but this is a slower rollout than we thought. There are legal challenges, which is slowing it down. And there's also diminishing returns. Increasingly, as we go forward, it's going to take an increasing amount of resources to find individuals, detain them, process them, and the like. So what do we know about large-scale deportations? In the last 100 years, we've had three of them. One in the 1930s, 30 through 34, in the Roosevelt administration. We had one in the 1950s in the Eisenhower administration. That was 1.3 million people. But in that one, about 500,000 were given temporary work permits and came back under the Bracero program. And then in 1964, those 500,000 disappeared from the labor force. And then we had this Secure Communities program, which was rolled out county by county between 2008 and 2014. There have been a number of economic studies of these episodes. And in the article that I have in the book that you got, you'll see some references if you want to dig into it more deeply. But they unambiguously say housing prices go down, income goes down, and unemployment goes up in these immigrant-heavy communities. So why is that? Well, let's talk about unemployment. If people are removed from a community, they're not there to go to theaters, to shop in stores, to send their kids to school. So the demand for those services goes down. And the folks that are still in the community experience more unemployment. You need fewer retail clerks, for example. Also, there's complementarity, and the way to think about that is a home builder who's building a whole bunch of homes every year. If they lose part of their workforce, if they lose roofers and drywallers, so that they have a smaller set of workers in those particular occupations, they can build fewer houses. So they need fewer of the other people. And so we see higher unemployment. So what do we see for California? Well, the first thing is how exposed is California to these policies. And California is to the left of the vertical line there. And I want you first to focus on the blue. These are the estimates by state of the top 5 states as a percentage of population of the undocumented folks living in those states. And you see California is not the most exposed. Texas actually is. But California was quite exposed. And then if you add on that temporary protected status, the TPS, that's the orange block. And California is not really very exposed to that. The vast majority of those with TPS in California are from El Salvador, and their status was just extended for another 12 months. So all the way into 2027, they're not at risk. Actually, Florida is has the highest risk with Venezuelans and Haitians who have TPS, which the administration has promised to let expire. But nevertheless, California is very exposed. And so we did a study comparing unemployment and the change in unemployment in the first 8 months of 2024 with those in 2025, and asked, to what extent is that difference between 2024 and 2025 explainable by the deportations? And so we have to kind of weight that by sectors such as leisure and hospitality, agriculture, and construction that have a large percentage of the workforce potentially undocumented. And when we do that study, what we find is that a 1% increase in foreign-born increased the unemployment rate by 0.1 percentage points. So that's pretty small. And as a cautionary note, these estimates are fairly imprecise. But what that tells us is that, yes, it has begun, same thing that we saw in previous episodes of large-scale deportations, but it's really kind of fairly minor at this point. And so that influences our forecast for unemployment. 3 months ago, the forecast for unemployment had California's unemployment going up into the 6% range. Because of the slow rollout and the evidence that we have that is only having a minor impact at this point, we've lowered that. And so we've got it going up to a high of 5.9% in one quarter. You see the average for the year is much lower. And then it declines, and we have it declining much more slowly because of this slower rollout is pushing some of those deportations into the future, ending up at a higher level than what we had before at 4.5%. Okay, so now turning to sectors, this is manufacturing, and this is the latest data we have. Again, we know the direction, but we don't really have any recent data because of the shutdown. But you can see on the right-hand side, manufacturing output in California is down. But we're optimistic about this sector for two reasons. The first is the industrial policy that Clement talked about resulted in a number of factories, a fairly decent number of factories being built in California. And building a factory takes 4 to 5 years. They'll be opening up in the latter part of 2026 and 2027. So we're expecting that growth in manufacturing then. And then the aerospace industry, we have increased demand for airplanes, increased demand for defense durable goods, for satellites, for launch services. That disproportionately affects California. That is ramping up also. And again, we're expecting that in the latter part of next year. So manufacturing, durable goods manufacturing is going to be a bright spot as we go forward. But keep in mind that almost 2% of our manufacturing workforce has been laid off over this past year. Turning now to tech, and what you have with tech, so there's no real tech sector. So the red line is professional and business services, and keep in mind that that also includes legal services and accounting and so on. And the blue line is computer tech. And as you see the decline there, those are those announced layoffs that we heard about. But if you look on the right-hand side, it seems to be flattening out. And there have been announcements of some additional layoffs, but we're optimistic here for two reasons. One is AI, and there's been a lot of investment in AI. In the first half of 2025, 2/3 of the AI investment came to California, right? AI is driving the US economy. 2/3 of that investment is here. And KPMG reported that in the third quarter, the 10 largest investments in AI, venture capital investments, of the 10, 7 were in California, comprising 90% of the funds. So that investment is really going to be driving California. There's another, which you may or may not have heard of. How many have heard of AI slop? Not too many. So I need to tell you what AI slop is. When you do an email and you're typing computer, kind of AI driven, will try and finish your sentence for you, right? And that's the way that these large language models work. And you say, you think about it, not always do you accept it. A lot of times you say, that's not really what I want to say. Well, if you're using AI to develop a complex AI application, no one's standing there saying, or sitting there saying, no, that's not what we want. It goes and develops it. And so it's going to make mistakes. And those mistakes are going to be compounded as it continues to build the code. And what you see when you're looking at the application is, well, the code isn't doing what I want. So then you tell the AI, we'll fix it. And if you work with ChatGPT, there's an iterative thing. And the way in which it works is it puts another module on to try and fix it, which tends to compound the problem. And so there's a whole tech sector growing. It's mostly independent contractors, but now some startup firms, and growing here in California to clean up AI slop. So demand for workers in tech is going to be increasing. So that's also a bright spot for California. Turning now to Hollywood, and you might recall that this decline in employment in Hollywood, pre and post strike, the strike is the shaded area, that is related to a contraction in the entertainment industry because of overproduction of content, and it seems to have flattened out. Now, we've heard about further consolidation with Paramount, et cetera. And if you look on the right-hand side, which is Film LA data of days of filming in Los Angeles, the black is 24, first 3 quarters. The blue and green is 2025. You've got a decline there. And this decline in employment in entertainment is about half of the differential between the US and California's unemployment rate. But we have countervailing forces here because the state has passed a subsidy for entertainment to prevent runaway production. Now, this decline is nationwide, but more acute in California because a little more runaway production. So we have these two forces working in opposite directions. And so our assumption for purposes of the forecast is not that we're going to get growth here, but that it's no longer going to be a drag on the California economy. Turning to logistics, so this is goods moving through the ports of Southern California, and those are huge ports, so we have to put them on a different scale. That's the red line. And then the blue and green are the Puget Sound and San Francisco Bay, the blue San Francisco Bay. So those are much smaller ports, but these are all the West Coast ports. The huge ports, if you look there, that's stabilized, right? So in terms of supporting logistics, we don't have evidence here that the logistics industry is going to be contracting. Now, there's a little bit of contraction in the other 2 ports, but a lot of that relates to the fact that China was not purchasing U.S. agricultural goods, which flows through those ports. So this is certainly positive. And another positive thing is air cargo through California's airports. The top is Southern California, the bottom is Northern California. And you can see that it's kind of stabilized in Southern California. In Northern California, it's growing. And part of that is that wealth effect that Clement talked about. That's where AI investment is. That's where income growth is the greatest in the state. And we're seeing evidence of that in terms of goods movement and package movement in Northern California. Turning to housing. So I've been giving you good news. Housing, not so much. As Clement said, nationwide, the housing market is frozen in terms of new production of homes. And you can see on the left-hand side, still in depression level of sales of single-family detached homes in the state. In fact, people are starting to take inventory off the market and waiting for better markets. On the right-hand side is home prices, and they're still very high, but they're no longer declining. They're no longer increasing, so they're kind of flat. And what that has resulted in is no real increase in home production in California. In spite of the new laws that California has, and in spite of the need for new construction because of the wildfires, we don't see any increase. And it's because builders are uncertain of their costs. High interest rates affect both construction loans and the demand by consumers, labor shortages, and uncertainty about prices. Builders don't know what price they're going to be able to sell their homes at. So that gives us a very muted forecast for home construction in California. So to summarize, we've got in 2025 flat employment growth and positive income growth. So California's actually been growing faster than the US, even though it's been declining in employment. And then the first half of 2026, more of the same. Second half is when things start happening. We start getting growth in tech, in manufacturing. There's some question marks about construction, finance, leisure and hospitality. And then in 2027, a return to superior growth from manufacturing, tech, construction, and tourism. And just some numbers for you. And you notice looking at the bottom, so we get a 20% increase in home production by 2027, but we're starting from a really small base. And 122,000 new homes just doesn't move the needle at all in terms of affordability or the housing shortage crisis. The unemployment rate averaging 5.5% and then declining to an average of 4.6% in 2027. Not much in the way of employment growth on average for the year until we get to 2027 when it picks up and we get that recovery in employment. And then to conclude, let's go back to the Winfield-Scott. So this dead reckoning forecast, that we've been kind of working with, we know the direction, we know the speed, but we're in a California marine layer, so we can't see the coast. That was the case in 1853, with the Winfield-Scott loaded with passengers and gold coming through the Santa Barbara passage, encountered Middle Anacapa Island, and this is the Winfield-Scott from 1853 to now. So that's a cautionary note about not just our forecasts, but in forecast today, working with this limited data. And that concludes the California forecast. Thank you. And now let's turn it over to Ryan and hear about the AI bubble and whether or not our bubble is going to burst.
Thank you very much. Thank you, Jerry and Clement, for inviting me, and thank you all for being here today. So yeah, I'll kind of focus on, are we in an AI bubble, and then the consequences of that, if that is true. So are we in an AI bubble? I wrote this op-ed with Jared Bernstein 6 weeks ago, and we said, evidence points to yes. You can't definitively say yes or no. If we look at what we can see right now, we think more likely than not. So this was 6 weeks ago. A lot happens in 6 weeks in markets. I don't have to tell this room. So since then, we've seen more evidence pointing to one, yes, and two, also the market is starting to agree. So I don't know if you all saw this morning, Microsoft, there was a story that came out that said Microsoft is reducing its AI sales targets. They told its employees, the stock went down, I think 2.5% or 3%. Then a correction came out and said, no, it's the AI sales growth targets, and the stock recovered. So you can see the market's kind of on edge about these kinds of news about AI in the economy. So why do I think right now the evidence points to yes? Well, one, valuations are really high. So since ChatGPT, we've seen valuations. So there's two sectors you really want to look at, of course, here. These are the GICS sectors. So this is tech and comms, metas and comms. These valuations have risen for tech and comms by 25% and 44%. So what I've done in this chart, which is probably too small for you to see, and I kind of knew this as I was making it, which I regret, but I've indexed all the P to E ratios to when ChatGPT came out, November 30th, 2022. So 100 is the P to E ratio there. So I've taken the data back. These are 12-month forward P to E ratios, which go as far back in Bloomberg as 2005. And so you can see they're historically high, one, so I've kind of shaded out the other sectors. Financials also have pretty high P to E ratios right now too, so I've shaded out kind of the other sectors. And the three highlighted ones are the market, which is in the dark blue, the S&P 500, and then tech, and then comms as well. And you can see since, this is the inset, it's zoomed in here. You can see since November 30th, 2022, we've just seen an extraordinary rise in the P to E ratios, right? So keep in mind, these are the valuations. These are not the earnings themselves. This is nothing, this is not AI revenue or anything like that. It's just how the market is valuing that. So anytime you see a big rise in valuations like this, you might start to think, is the market getting ahead of reasonable expectations for profits? So another thing that everybody here is, I'm sure, is very well aware of, is that there's a lot of AI spending. As Clement just noted, it's driving a lot of the economy right now. But what about the AI specific revenue? So I'll talk about this in a couple seconds, but people will say, well, these companies have very high revenues, so maybe it's not that big of a deal. So if we look at, so this is something I've just kind of estimated, and this is a rough estimate, but here in the dark blue, you have the CapEx and the R&D on AI. And then in the light blue, you have the actual revenues from AI. So what you can see in this year, for example, Amazon has spent around 120 billion. I tried to be more conservative on the CapEx R&D numbers and kind of more generous on the revenue numbers. But no matter which way you want to slice it, you can see these are less than 10% of the amount they're spending this year. Now, of course, you don't expect CapEx to return something immediately in a year. A lot of companies are budgeting out 5 to 7 years for these kinds of investments. But still, that's an extraordinary difference in between the revenue you're getting from a segment and the investment you're making on it. Again, nothing dispositive by itself, but something that I think is suggestive. Revenue projections here is another thing that I find concerning. So whenever you hear, okay, the demand is going to be so high and we're going to make all the money in the world, you might start to get a little nervous. So for OpenAI in particular, its revenue to justify the valuations is expected to increase by 17x. And this is on a baseline of $12.5 billion. And that baseline, I think, is important because $12.5 billion is a lot of money. So to 17x $12.5 billion, you're going to have to really make a lot of new revenue from that. So this is $213 billion. I think this is from an article in the Financial Times. I think it's from HSBC that actually put this together. So that's by 2030. So in 5 years, you're going to $230 billion. That's revenues of something like Costco, for example, within 5 years. And then even then, whenever you look at their financials and their planned CapEx, this is again something they put together. They're still forecast to lose $77 billion. That's their profit in 5 years. So we're going to have revenues. So we're hearing two things. We're going to have revenues go up by 17x, but we're also going to be losing $100 billion 5 years from now. This is a $1 trillion company, by the way. So if people right now are valuing this at $1 trillion, you might start to say this is a little detached from a reasonable expectation of future profits. Again, that's how economists typically think about bubbles. So everybody's really hoping it works out. And I think an instructive example here, it's the key part of this ecosystem, is Oracle. So their revenue is expected to increase by 16x. So again, this is on a pretty high baseline already. I think their current revenue from the cloud infrastructure revenue, which is kind of their AI segment, is around $5 to $10 billion. And we see it's forecasted to get $150 billion, and it's going to surpass their CapEx here, which is the dark blue line. The light blue line is the revenue. What's really concerning is 2/3 of this is coming from one company, and of course that's OpenAI. So we're saying, so you start to see the circularity of it. Revenues are going to increase. OpenAI is going to have a ton of revenue increases, and that's going to drive revenue increases in Oracle, and that's going to drive revenue increases elsewhere. And you have this kind of circular financing structure, which in and of itself may not be a big issue. But if you don't have the end user clients yet, that's where you might start getting concerned. Meaning, for this to work out, for these valuations to come true, you're going to probably need two things. You're going to need a lot of advertising revenue, which is what ChatGPT just yesterday said they're going to pause. And more importantly, you're going to need the enterprise clients. So we're talking ChatGPT for your firm or something like this. And I'll talk about the difficulties of adopting that at a quick pace. So are we not in a bubble, though? So here's Jim Cramer. He says he's not worried about it. So if you think we're not in a bubble, you're with Jim Cramer. So, I don't know if you're an investor or not. I don't know how good you'd feel about that. But he does have a button that he smashes on TV when he wants to make money. So that's a good sign. So one of the arguments you hear people say whenever they say, well, we're not in a bubble, and I just kind of reference this is not like the tech bubble. Tech bubble was at pets.com. They had no revenue. You had all these firms that were getting these sky-high valuations. We are talking about companies that are at the leading edge and are incredibly profitable. And this statement is absolutely correct. So what I've done here on the left, I've plotted the Mag 7 earnings, and then in the green box there, that's a forecast for next year. So you can see they made $600 billion in net income last year among the Mag 7, which is extraordinary. So these are, in fact, very profitable firms. The one on the right is from Bloomberg. That shows how much cash different tech firms have. They have $1 trillion in cash, okay? So we've seen arguments of, well, now they're starting to debt finance it. There's, I think, $150 billion of debt financing, but still, in my opinion, not that big of a deal for the firm's solvency, okay? So this is true, but there's a big problem whenever you extend that to say, well, they're financing it with cash, so we're not in a bubble. And this is something that economists know and love, which is Modigliani Miller. So if you're not familiar with this is kind of where corporate finance starts. And this says pretty much equity, debt, it doesn't really matter how you finance the company. The thing that matters is the net present value or the profits of the company that are going to return to shareholders. And so we know this is wrong in some senses, or in many senses. Again, this breaks, and that's kind of where corporate finance starts. There's a pecking order. It matters if you finance it out of retained earnings, debt, or equity. We know different ways on the margin in which financing your company is going to be very important. So it's good to have cash to do that. But whenever you're talking about spending $120 billion in a year, it's not really going to matter if that goes upside down. So just as an illustrative kind of example, if you remember the Batman from 2008, and the Joker set this huge pile of cash on fire, and he said, I'll do a Joker impression. It's not about the money. It's about sending a message. Okay. So if you imagine Mark Zuckerberg decides to cash a pile of cash on fire, that might be bad. Now, what if Mark Zuckerberg said about this? He said, if we end up misspending a couple $100 billion, I think that's going to be very unfortunate, obviously. So, if Mark Zuckerberg, for pro tip for those at home, if you use AIs, the LLMs, the only one that would let me Photoshop Mark Zuckerberg's face on was Grok. So it's like kind of the kid that's not good at school, but they'll ask you if you want to smoke cigarettes at recess or something. It'll let you do kind of more naughty things like this. So if you need to do something, you're definitely got to use Grok for that. So if Mark Zuckerberg lights a couple $100 billion of cash on fire, okay, that's got to matter for share prices. Why? Because that's money that's not coming back to investors. So does that mean Meta or Google or Apple or Amazon or any of the Mag 7 or big tech companies is going to go bankrupt? Absolutely not. The solvency of the firm might be fine. But that means if you're holding those shares, that's not dividends coming back to you. And that's got to weigh on the share price. Otherwise, finance is really broken. So with that being said, do I think AI isn't transformative and am I an AI bear? Absolutely not. I think AI is 100% transformative. And we've seen this. Everybody in this room, I think, has lived through the dot-com bubble. We've seen transformative technologies, but a bubble happens first. The internet had the dot-com bubble, but again, the companies that could harness the power of the internet, as that graph just showed, $600 billion last year alone in net income. So this is kind of a dumb exercise, but it shows you there's a left axis here, which is Oracle and Amazon. The right axis is, Oracle and Texas Instruments. The right axis is Amazon and Apple. The point being is, had you invested in Amazon or Apple at the beginning of the tech bubble, today you would have made a return on your investment of 25,000. You would have 25,000x that. Why? Because they were able to harness the power of the internet. So likewise, I think there's going to be firms that are going to harness the power of AI, and it's going to return a lot of cash to shareholders. The question is, nobody knows which firms, so there's a cross-section issue, and nobody knows when. And those are the two things right now where I think kind of this AI fairy dust has spread around enough to where we think it's more likely we're in a bubble than not. So how do we think about AI's impact on the economy? So here's my framework, the way I think about it. Even at this point, if you hate AI and you think it's filled with slop and you think it's really bad, you have to admit it's very useful for a lot of things. So I use it to code every day. People use it for, summaries of legislative text. There's all kinds of business cases. So I don't think anybody at this point can say, at a minimum, it's Microsoft Excel, which is a great innovation, and a lot of bookkeepers, all of us use it to do things automatically. So I think if you say AI is terrible, you even then have to admit it's, at least in terms of productivity boost, a Microsoft Excel kind of analogy. Then if you want to take the maximalist direction, you want to say it's the electrification of the factory floor. It's something that's going to change our lives every single day. It's going to change the economy. It's going to lead to a lot higher productivity. So the question is, where on this continuum are we? So obviously, if you think it's Microsoft Excel, we're in a huge bubble. If you think it's electrification of factory floor, which I think it's actually closer to, we might still be in a bubble, but it just might be that it takes a lot of time. And this is what the insight is from the economic literature. It takes time, one, not only for firms to adopt new tech. So I'm sure many people here at your firms or institutions, you have some sort of AI model that you're using right now. The security people are nervous about it. The lawyers are always nervous about everything. So, it takes time to implement that, to get people to use it. The other thing too is it takes time once you adopt it to also optimize how you're using it. So how do we plug this into our workflow really fast? How do we enable this to allow our software engineers to be more productive? How do we enable this for our salespeople to get reports on through their CRM software? This isn't just overnight you adopt and then you implement it for its optimal use. So for example, electrifying the factory floors took 30 years. Why is that? Well, once you just plug in electricity to your factory floor, you then have to think about what's the best processes now that I have everything electrified. So you're shifting around equipment, you're shifting around people, you're changing shift times. All of these things take a while to understand the benefits of. And to give you an example, in 1900, only 5% of installed mechanical power was provided by industrial electrical motors, okay? By 1930, this was 80%. So huge adoption, took 80 years, but keep in mind, still 20% of installed industrial electric motors was not electrified. And that's 30 years later. So what we know now, maybe AI is faster, sure, but is it much faster than this? I'm not sure. Maybe it's 5 years, maybe it's 10 years, maybe it's 20 years, but the further out it is, the more likely I think we're in a bubble, because again, investors are pouring a ton of cash into this right now. They might be patient, but if you say your money's not coming back to you for another 30, 35 years, you're going to really adjust your valuations. And the internet wasn't overnight either. And obviously, I think most people know this quote, but Robert Solow, the Nobel laureate, famously said, you can see the computer age everywhere but in the productivity statistics. And the reason for this, again, was you had a lot of adoption of firms using computers, and you saw computer sales and adoption, but they weren't figuring out how to best use it. And we also had revisions to the productivity statistics as well, but this was kind of one of the main drivers of that. So some good news, I think all else equal, if there is a bubble and when it pops, fresh in most people's mind is the great financial crisis. Me and Jared don't think it'll be as bad as that. So one, the distribution of returns isn't as extreme as the dot-com bubble. So what I've done here on the left is I plotted the distribution of 3-year returns. So whether that's on the top here is 1997 to 2000, on the bottom is 2022 to 2025 since ChatGPT was released. And it's hard to see here, but the point of this is you have this huge right tail. So this number here, for example, you can see a lot of the masses. This is like a 60% 3-year return. So you can see one in the top here, which was the dot-com bubble. There was a lot more clumped kind of further right. And then you had some of these going way out. There was like, 1,100% returns, 1,300% returns. Versus here, you don't see the same kind of excessive return profile. So in terms of how much the bubble's inflated, I don't think we're as inflated as the dot-com bubble. The other thing is investors might be a little more patient. So what I've done with this graph here, and again, there's all kinds of conceptual problems wrong. I don't want the UCLA finance people to take me to finance jail here, so I'll caveat this appropriately. But I've taken the S&P 500 dividend strips. So what this is, if you're not familiar, it's just effectively, it's saying you're going to get the profits of the stock market at different points in time. So I'm going to give you the profits from the S&P 500 in 0 to 2 years, or 2 to 5 years, or 5 to 10, that's the green. And then the 10 years on the right axis, because and that's the line. And what this graph shows is over time, investors have valued more highly, it's made up a higher percentage of the present value of the S&P 500, these further out cash flows, meaning they're willing to wait a little more. I mean, that's, again, rough interpretation. There's interest rates in here. There's all kinds of things with, your risk preferences. But, this is just kind of it's secularly been increasing. Do I think this is related all to AI? No, but I do think investors do have a recognition that this isn't going to accrue immediately. But I think they may be over-optimistic on how soon. But again, I think investors are more aware. So I think that's kind of the better component. Here's the problem with what I have italicized at the top, all else equal, is the policy response will not be equal if there is, in fact, a recession. So, again, with the administration, I would guess, as Clement said, they're going to have people that are going to be more dovish. They're acting more dovish. In February, which is all you should all mark your calendars if you don't already have this. At the end of the month, they reconfirm all of the central bank, all of the Fed regional governors. Typically, this is a pro forma process. They just do it automatically. But the board, which is the ones that Trump appoints,
has to approve of it, and they can reject anybody they've never done this. They can reject anybody for any reason. So there is a potential for at the end of February for the Trump administration, the board, which Trump will have a majority at that point, to say anybody that could serve on the FOMC and might be hawkish, you're off. You're no longer the president of, for example, the Chicago Fed, Austin Goolsbee. So they could have a fully stacked FOMC, and the response might immediately be, as Clement said, take interest rates to zero, and let's get the stock market back up. So we know the stock market is going to be the first to fall. That's a lagging indicator, or leading indicator rather. And it'll probably be the first thing to rise. So the thing I worry about is the administration seems to very heavily index on the stock market as a measure of performance. And so I could see a situation in which we go into recession, they cut interest rates very aggressively, the stock market eventually responds, and they kind of say, job done. But what are the things you really need to do for countercyclical policy? Well, you need to have probably some fiscal support, although as Clement noted, that's getting more challenging with our limited fiscal space. And you need to have a very robust social safety net to ensure that there's some, one, for humanity, but two, to ensure there's some minimum amount of demand in the economy, right? People are still getting paychecks, they're still going out, they're still going and doing things, even if they lost a job to no fault of their own. And so are we going to see big pushes on that? To their credit, the administration did do the CARES Act in 2020, which is a huge fiscal stimulus and absolutely helped the economy a lot. So the question is, if we do go into recession, what is going to be from an AI bubble popping, what is going to be the administration's response? And if they just look at the stock market and say, job well done, that's going to be a big problem. All right, that's all I have, I think. I don't know how, oh, okay, perfect. I have, I guess, like 5 minutes for Q&A. Yeah, thank you.
More general Q&A. Yeah. So thank you.
Thank you.
And I didn't think it possible, but you made both Clement and myself look like optimists.
I'm generally optimistic by nature, so yeah, this was a surprise for me.
Yeah. So we have a few minutes for Q&A for our in-person audience, and let's start off with Thomas.
So I have a question for Ryan. I like your scale. Thanks. I like your scale between Excel and electrification of the factory floor. And I tend to be more on the side of the electrification of the factory floor, but I wonder how much time or whether you've thought about the fact that the electrification of the factory floor can't tell you how to electrify the factory floor, which one thing that with AI is you can actually ask AI, how can I best use AI and what am I missing? And what are other people in my industry doing, which installing electricity can't do?
Yeah.
And whether that makes you more or less optimistic.
Yeah, no, I think I agree with this in the sense that it makes me more optimistic. It allows you to do this, but there's still a lot of non-technical barriers to having widespread adoption. So, I mentioned, for example, the lawyers, like the AI will say, go chat with your lawyer. And then the lawyer is going to say, oh, I don't know, we can't do X, Y, and Z. And so that's going to kind of stifle it. And for example, you see a lot of with healthcare, this is a really big issue is we know there's a lot of promising uses of healthcare with patient data. But we have HIPAA, we have all these regulations. So to be able to integrate that and use AI to improve healthcare a lot, there's regulatory concerns, and there's also going to be a policymaking issue. So I think policy, I would absolutely expect it to penetrate further than the factory floor. But the businesses, like for example, JP Morgan apparently has a great AI system that's internal to them. And apparently they've figured this out really well. And so you'll see the large firms, I think, pick it up pretty well. But if you think about, for example, once we're getting these kind of terminal valuations, if you think about, the grocery store on the corner or something like that, they could definitely use AI, but I don't think they're going to be using AI anytime in the next 5 to 10 years. But again, maybe in 15 years, all their systems already come preloaded with all this and they're trained on how to use it and everything. Because there's also a training component too with how do you best use AI. Even somebody like me who uses it for coding and software and econometrics, as I'm sure Clement does as well, you have to learn what it's good at and what it's not good at. And if it's bad at some things, you have to learn that sooner rather than later. Otherwise, it's a negative effect. But so yeah, I'd say I'm optimistic.
I would also add to that it's not clear how good AI is going to be at thinking outside the box. And your question is really about how, when we have these new technologies, we have to think outside the box about how they're actually most productive. And so if you go back to the 1900s, when we got the first types of large-scale manufacturing, the technologies that came there were interchangeable parts. They were like standardized equipment and the likes, right? If you just put that into the small little craft shops that were existing at the time, that would just replace labor, but it wouldn't really add much to aggregate productivity growth and output, right? And that's how we talk about AI right now. Oh, it can just replace the workers that are already doing these tasks. But that's not where the real value of AI is going to come from. It's going to come from this idea of completely reinventing how manufacturing was done, but in this case for services, right? So the manufacturing gains came from when we completely reinvented how to do manufacturing from small little craft shops to mass scale manufacturing because of this new technology, right? But that wasn't clear how to do that. And the brilliance of Ford was that he realized how to do that, right? And so we're still waiting for those geniuses to come along to say like, oh, look, we can leverage this new technology in this completely new way that nobody's thought of that's going to massively increase productivity and growth.
Okay, questions for any of us, and all the way over on the left.
And they with corporate clients, but what about government use of AI?
Yeah, I mean, again, I'd fall that under enterprise. So, you know, if you have big contracts, and you've seen again, I think the top performer of this year maybe is Palantir. They're definitely close to up there, and so they'll say they're an AI company. I mean, how much that's true, who knows? But they're definitely benefiting from a lot of those big government contracts. So I absolutely think that's a piece of the puzzle, but that alone is certainly not going to be high enough to, I think, justify a lot of the spending that we're seeing. I mean, really, to me, the question is, who's going to be able to provide the next Microsoft Office? And what does that look like for enterprise customers, including the government, for example? So, you know, I think most people, I mean, the user base of ChatGPT is very high. It's something like 700 or 800 million people, I believe, or just LLMs in general. It's very high in the United States. So individuals are using it, but they're not. I pay $20 a month for ChatGPT Pro. They're not going to make back, you know, $100 billion off me paying $20 a month. So it's really going to have to be, when do we see kind of these very large, very productive firms implementing these? And right now, kind of one issue is our most profitable firms are all these tech companies, which themselves have their own AI. So unless they start buying from each other, you know, it'd be a little weird if Google's like, okay, we're going to have ChatGPT's AI instead of Gemini or something like this. So there's a bit of a problem there, but yeah, once you see more widespread adoption, but I absolutely think government, both state, local, federal, there's a lot of room there. Sure, yeah.
Saudi Arabia, one of the US-based AI firms. So
Interesting.
it's like a completely untapped potential.
Yeah, I'm a little nervous of what the Saudis are going to do once they figure out AI, but I totally agree. I mean, this is all over the world, right? Like Microsoft Office is used all over Europe and everywhere else. So again, kind of like it's not only the US, but it's the rest of the world. And that definitely includes government customers. It includes academic institutions. So I'm sure UCLA, Stanford, there's like an AI playground, which they've you know, had an agreement with all the big AI companies. So, you know, and I do believe this will happen at some point. The question is when and on what scale.
Yeah, question.
Yes, you mentioned Google and Gemini. I'd love to get your thoughts on Google and, you know, them making their own chips, how that plays into NVIDIA. And then also, why is no one talking about DeepSeek anymore? That was another moment that, you know, kind of changed everything and moved the markets. And now no one talks about DeepSeek at all.
Yeah, so the view in Silicon Valley, I think, that people probably have is Google is the smartest and they've kind of been sleeping and now they've woken up. So I think with the chips, it seems to me they're just going to kind of take, I mean, Jensen Huang was on CNBC yesterday kind of saying, oh, it's not a big deal and they're going after a different market. But then I talked to somebody else and they said, no, they're just going to eat NVIDIA's lunch now. So I think that'll be good for competition in terms of the product quality improving for sure. But again, for the profitability, it might be they're just taking NVIDIA's profits and adding it to Google. So for the industry as a whole, how much value add that is. So to your second question with DeepSeek, one thing that all the big LLM and tech companies said is, well, we have all kinds of models like these. We just don't roll them out. So these are kind of the cheaper models. And you saw the huge impact that had on valuations, for example, NVIDIA, whenever that came out. And as you said, like there's not a continuing concern. And I think, you know, again, I'm not a technologist or technical person in the AI space, but my understanding is kind of we've arrived at an equilibrium where we say, okay, we're going to have these big foundation models, which is the PhD that you can talk to. And then we'll have stuff like DeepSeek or these cheaper kind of more custom models, which can kind of answer a question quickly for you. And from my understanding is the way markets value that if they'd understood, okay, these are two different product categories.
And we had a question over there. Oh, yes, please.
Hi, I work for a bank. So one of the things that we're dealing with all the time is fraud. How is AI going to be dealing with like cybersecurity? Where are you seeing that?
Yeah, so again, I'm definitely not a cybersecurity expert. I have a friend who, worked in the intelligence community for a long time doing cybersecurity. He's now at DARPA. It's really a cat and mouse game they're playing, obviously, as I'm sure your bank is, because we just saw this. China used Anthropic to a bunch of US companies. And so the AI is definitely helping with that. So some of these more kind of common hacks, the AI is able to say, okay, you're trying to exploit this one vulnerability. So whenever companies broadly have a huge hack that happens to them, sometimes it's not, like some guy sitting in a van hacking into the mainframe or something. They're just running a bunch of different programs saying, hey, there was this old bug, maybe they didn't update one of their computers. So they're running Microsoft, or they're running Windows 10 instead of Windows 11. So try that and see if it works, and see if it works on this vulnerability that everybody knows about and they've since patched. That's how a lot of the hacks at large companies actually happen. So I think AI is good in that sense, because it could sit there and go through and say, oh, okay, somebody's trying to run this executable on Windows 10. That's probably this bug that was patched. At the same time, though, what we're seeing with Anthropic and China's hacking is, I think you can also on the same side use it to make much more sophisticated hacks. So the offense is going to get better, the defense is going to get better. So yeah, and this is kind of, I think, just continuation of what's already happening without AI, obviously, and hacking and cybersecurity.
So we have time for one more question. There was someone over here behind Francis. Yeah.
So really quickly, aside from the AI transformational nature, right? So we know that there's a good thing and there might be some drawbacks on that. But what's your take on, we're hearing a lot of shadow banking right now, where banks are not directly investing in these tech AI platforms, but through private equity firms. Now, do you also see that the AI bubble is a byproduct of lack of regulatory scrutiny with regards to shadow banking?
Is this for me or
anyone? Because obviously we're seeing, as your slides depict, that there's high valuations, and then the projections, 5 years, 10 years, still less of a revenue. So is this again because of lack of regulatory scrutiny, and then the whole shadow banking aspect of funding AIs through private equity firms?
Well, I think there are real questions about shadow banking and private equity. And if I could ask you to postpone your question, because our keynote is going to talk about these issues.
Awesome. Okay, thank you. Getting ahead of myself here.
And we'll have time for that. But there are real questions because there's some opacity with respect to what shadow banking and private equity is doing. And as he's going to talk about, it's not just, private equity is not one thing. It's just kind of a whole menu of different kinds of companies. But maybe if I could finish up before we go to the break with a perspective on AI. If we think about big transformations that have happened, like the Industrial Revolution, AI is going to be one of them. Now, what did the Industrial Revolution do? It was a democratization of physical work, right? It had machines augmenting work. So someone who couldn't, because of their physical capabilities, lift a heavy box, now had a machine to lift a heavy box. And so you get this equalization, and that's a real productivity increase. The timing, and I think you're exactly right, we don't know the timing for AI, but it's going to do the same thing for cognitive abilities, right? It's going to be not a complete equalizer, just as the Industrial Revolution wasn't a complete equalizer, but it's going to shrink kind of that gap in cognitive abilities, and that will definitely be a long-term productivity increase. Now we're going to take a 10-minute break, 10 minutes only. We have a great panel coming up, and then following the panel, our keynote. So see you all back here in 10 minutes. Okay, we're ready to start the second part of the program. We have a great panel here, and our moderator, Yola Kairos, is part of the board of a member of the board of the UCLA Anderson Forecast. She studied at Cal State Northridge, at Laverne, and at Loyola Marymount, holds a JD and an MBA, has a list as long as your arm of certificates and licenses in securities, is now with JP Morgan, and her current title is Executive Director and Banker in the Los Angeles office of JP Morgan Private Bank. I urge you to read her biography. It is very long, and I don't want to take time from the panel, but Yola has been a really valuable supporter of the forecast and of UCLA, and I'm looking forward to a great panel. And let me turn it over to you, Yola.
Thank you very much, Dr. Nicholsberg, and thank you all for joining us today. It's an absolute pleasure and a privilege, and we're honored to be joined today by three esteemed panelists who have all shaped the financial services industry in key ways. Allow me to first introduce you to Mr. Walter Wicks, who is the Managing Director at BRG, also leads the financial services leadership practice at the firm. In his role, he and his team advise domestic and international banks, as well as financial services firms, on all aspects of compliance, regulatory processes and navigation, technology implementation, particularly as it relates to AI, and of course, risk mitigation. Prior to his role at BRG, Walter also was the former commissioner for the California Department of Financial Services and Innovation. And Walter played a key role, he and his team, advising Senator Bill Hagerty and his team, who co-authored the Genius Act, which is a seminal piece of legislation highly pertinent to the topic today. Welcome, Walter.
Thank you very much.
Christian Kuntz is the Executive Vice President for Treasury and Payments for Zion Bank Corp. Christian Kuntz was pivotal in her team leading a core digital business transformation for Zion Bank Corp, which took over a decades-long initiative, which was highly successful and highly innovative for her firm, and particularly within the regional banking sector. We'll learn a little bit more about some of that innovations, both her challenges, but also the opportunities that unfolded and were unlocked through this initiative. Prior to joining Zion Bank Corp, Christian also advised financial services firms and banks at her role at PwC. For context, Zion Bank Corp has 90 billion of assets. It was founded in 1873, based in Salt Lake City, and is known as, amongst its peer, a leader in small and community business lending and financing. So welcome, Christian. And then we're also joined by Ben Tsai, CEO and founder of Wave Digital Assets. Ben is also a crypto native, has been in the industry since the mid-2010s, navigating it in its nascent state, but also in his role at Wave, which advises individuals and investors on all aspects of digital asset advisory and venture capital. He also teaches at UCLA Anderson's business, as well as in their Masters of Financial Engineering program, a course on crypto finance and lending. Ben, I have to say, I wish I had that course while I was pursuing my MBA in JD, because I would have taken it in a heartbeat. So I encourage students to sign up there. So we're excited to talk to you about this panel and this topic today around stablecoins. Specifically, we are going to look at it from a lens in 4 categories. One, the taxonomy. What is a stablecoin? What is a blockchain? What does that mean? And we recognize that many of our audience members, both here with us in person, but also virtually, come with different varying levels of knowledge to this nascent industry. Second, we're going to talk about the opportunities and the value and the product market fit that digital transformation, specifically stablecoins, offers within the TradFi, which is short for traditional finance realm. And then we will also have a clear-eyed vision and discussion around the risks, the gaps, the challenges that this emerging technology poses, but also how firms are trying to navigate, are attempting to navigate their way through this integration with this particular asset class. And then lastly, some thoughts around the forward-looking strategy going forward. I want to take a very quick step back and just talk, just draw on some of the key themes that our esteemed panelists beforehand have talked about that I think is important to how we want to think about this conversation. Clement talked to us about the benefits and the growth and the potential, but also the risks within the U.S. financial services and the economy at large. Dr. Nicholsberg shared with us also how that fits within California, particularly the potential opportunities within AI investment, but also manufacturing and what that bodes for the labor market, but also some challenges when it comes to immigration and tariff policies. And then we also heard from Ryan his view and thoughts around where we are with AI and his very nuanced perspective around risks that he foresees from his analysis with his team around this particular digital transformation trend. I want to take build upon that in two ways. I think Dr. Nicholsberg brought a key perspective and theme in terms of how we want to think about navigating complex, ambiguous, and uncertain environments, and that is that ship analogy that he brought earlier. I think the quality of the questions that we need to be asking ourselves is what's most important now. I tend to stay away from getting into binary questions. Are we in a bubble? Are we not? Because I don't necessarily know that that's going to yield the best and most fruitful and thoughtful answers for us and help us navigate the uncertainty in the environment going forward, particularly as we're working about and talking about digital transformation, whether it's AI or stablecoins. Rather, I would encourage us to ask questions that would be around a lens of, what problems can AI and digital assets such as stablecoins solve for us now that were previously unsolvable before? And what is the economic value that it portends? We can look at it even more from a micro lens, is what is the marginal productivity unit of growth and of efficiency that's unlocked by these technologies? And who stands to capture it? And how do we position ourselves so we benefit from that trend? And from a different perspective, perhaps we also want to look at what are the risks, what are the gaps, what are the potential failures that this digital technological trend may portend? How do we, in pure finance parlance term, how do we protect our downside? How do we mitigate our potential losses so that we can maximize our upside opportunity? And if we take a look at it from that lens, it doesn't matter if we're in a bubble or not. Frankly, that's an irrelevant question. Rather, we can expect that there will be contractions. We can expect that there will probably within some time period be a recession. And we can also expect that if we believe this trend is headed forward, and the directionality is in a positive forward, then we want to be participating in it in some way, shape, or form in a rather balanced, thoughtful, constructive view, clear-eyed view. And so with that, let's shift and talk a little bit about stablecoins and what that means from that lens. So just to quickly set the landscape, stablecoins is a rapidly emerging digital asset representing about 7.5% of the total crypto asset market. Roughly that equates to about $300 billion in market cap as of September 2025. And that's mostly denominated by US dollar pegged stablecoins. Traditional firms, TradFi firms, JP Morgan and the likes, are actively entering the space, issuing stablecoins and deposit tokens. We have publicly released our JP Morgan deposit token that serves institutional clients, enhancing settlements faster, as well as 24/7 trading and cross-border payments. Additionally, a few weeks ago, we had launched our first real-world asset token that's backed and tokenizing an alternative investment on our asset and wealth management framework. And we're very excited about that for our clients as well. The Genius Act has also been released and passed in July, and that has defined payment tokens for us. But of course, there still is ambiguity that we'll talk about with Walter and the team here. And then, of course, the next logical step is that banks are going to, enter into this space. So it's no longer a question of whether stablecoins are a thing. Are they good or are they bad? Are they here to stay or are they not? But rather, how can we think about unlocking the potential innovation benefits that they offer, and while managing and balancing the risks, both attendant and emerging risks, so that we can ensure a safe and sound and upgraded digital US financial system, which we all here and the world depends and relies on and trusts. So with that, Walter, I'm going to turn over to you. Let's talk about taxonomy. Our audience brings, as we talked about, varied background, and we throw the word around blockchain and digital asset and digital token. But I'd love for you to walk us through what exactly is a blockchain and what is a digital asset, and specifically help our clients and our audience here understand what it means when someone owns a US dollar coin or a US dollar tether as it compares to, let's say, holding US dollar fiat currency in their bank account and payments?
Well, thank you very much. I like to describe myself as a recovered bank regulator. I've spent most of my career with one foot in the banking world and the other in the technology world, and actually created the first ever identity theft legislation in the country, which became a model law followed by the states and federal government. That speaks to, in my view, the ability to create a proper system that balances risks and opportunities together. And that's the kind of thing I think about in connection with stablecoins. So when I think about stablecoins, the first thing I think about is data. You have to have clean data or the house that you build will fall down. Okay, so that's the first thing to think about: data, data, and data. Of course, stablecoins reduce cost, increase speed. I also think about stablecoins in connection with security, proper documentation, and regulatory compliance. I think regulatory compliance in this space can be a competitive advantage. So back to Yola's question. The question, in my view, comes down to really a mark on a technology system, which is a permissioned or permissionless blockchain. And that mark is pegged to something of value. It could be to the US dollar, or it could be to a basket of stable coins or stable currencies. And that's what I think about. Everyone knows what a digital wallet is. So these are acquired through a digital wallet, which is really a contract that relates to the ownership of that stable coin.
Wonderful, thank you for that. And then Ben, I should say, not all stable coins serve the same purpose. We've talked about this. Some are fiat backed, some are resource backed, some are even backed by different types of digital assets, and of course, even algorithmic variants. There are different utilities and risk profiles, but I would love for you to talk about and share with the audience from your vantage point and your experience with the space. What specific problems do you see stablecoins solving that traditional financial firms didn't particularly, or instruments didn't particularly solve well?
Yeah, that's a very, very wide question there. I think there are two different components to this conversation. One component is that this blockchain technology has created a instantaneous settlement rail for different assets, for different tokens. And then once you have that framework, then you can talk about tokens and how they're connected to the backend assets that are backed. I think the most popular ones right now are backed by US dollars and US dollar short-term equivalents. Whereas people are launching other tokens that are backed with gold, that are backed with algorithms, or backed with other cryptocurrencies, and we're then starting to get into kind of a much wider subset, which I think would move a little bit away from the name stablecoin, but they're talking about real world assets where you can connect it with real estate, connect it with loans, and so forth. So that is actually a very wide and growing space, but the stablecoin area is a major part of that. So I think that's a good starting point. In terms of usage, I think it's interesting to think about this, and I'm a recovering former banker, I guess is probably the right way to say that. I come from a very regulated space. I was licensed at one point as a securities representative in Japan, Hong Kong, Singapore, Taiwan, and the US. And I come from that background. But when I approached crypto, I've realized that a lot of crypto was built before the regulations came into play. So it was really built from kind of engineers playing with finance, I think, for lack of a better way of saying it, and really thinking about, well, if I want to solve this problem, what is the solution? And let's not worry about the regulatory part first. And they've come up with a solution. And I think now we're getting to a point where, well, let's make it regulatory compliant. Let's make sure that these don't create loopholes where, it could be used for bad purposes and so forth. And there is a bit of pushback from the I wouldn't even call it the engineers, but really from kind of the crypto maxis on the regulatory environment that is now being placed upon the system. But in order for, I think, the system to be connected back into the traditional financial world, there does need to be some rails. And I think that is the debate between that connection with the traditional financial world where everybody is in and this new ecosystem, which is much faster, much more efficient, but potentially lacks some of these rails. And the regulations like the Genius Act are designed to put these rails in place so there's a common ground for people to discuss.
Now, Christian, you have direct experience with what it takes to integrate and create rails and integrate emerging technology with your efforts at Zion. I'd love for you to give your view and vantage point on the opportunities, but also the challenges of navigating that market and commandeering it.
Yes. I'm going to build on something first that Ben said, which is as we think about digital currency, just to make sure that everyone, I think we've got a varied audience, that everyone is really following here. If you think about digital currencies, I'm going to put cryptocurrency on the side as something different, and I'm going to put real world assets that are tokenized on a blockchain as something separate. If you think about digital currencies, you can have stable coins, which are designed to be stable and pegged to something, as Ben was noting. And then you can also think about deposit tokens, which Yola, you mentioned. So they're a little bit different. That's actually the representation of the US dollar on a blockchain versus a stable coin. In the simplest terms, you can think about it like an IOU, in terms of how the mechanics actually work. And so with a stable coin, if I buy some stable coin that Ben has issued, it's a contract to redeem that for whatever's backing it, right? So the US dollars, for example, if it's a US dollar backed stable coin, which is the subject of the Genius Act, I can then redeem that for those US dollars. So it's just a different mechanic. And I think it's important just to understand that foundation before we think about how banks will adopt this. Overall, what I think this means, and the way I think a lot of banks and people should be thinking about it, is this is new infrastructure. So we've relied in the US and in the banking world in particular on a lot of payments infrastructure that was built in the 1950s, 60s, and 70s. And so now the Fed did launch a real-time payment network in the 2010s. So we do have real-time payments that do clear 24/7. They are instant settlement, but they're domestic based. But that was really the first new set of major payment rails that were launched in decades. The ACH network, we're a top 20, we're a very large provider of payment services at Zions Bank. And so we're about the 40th largest bank in the country. We're the top 20 ACH provider. 62% of all the payments that we do for businesses are ACH. That network emerged in the early 1970s. So if you think about that, it's been sort of 50 plus years since we've had a really major new payment network. Now, real-time payments is there. Fed has their version with FedNow. They were a little later to the game. But in terms of payment volumes, those are still very small relative to kind of at least domestic payment volumes. In the last 12 months, about 87 trillion in payment transaction value processed on ACH. Now stablecoin is catching up, right? So we've seen a really sharp growth there, about 10 trillion in value in the last 12 months. So that's really growing. But then back to your question. So what do banks need to do? This is essentially yet another payment network that banks will have to integrate with and have to adopt. And so banks have experience doing this. They're very good and very trusted providers of payments. And so they'll have to work, obviously, to build those rails. And then there's new sort of regulation and operational considerations that come along with whether it's stable coins or tokenized deposits that banks and other ecosystem players will have to think about.
So just continuing to build upon your experience leading the digital transformation at Zion to the extent that you feel comfortable sharing, one of what Zion's transformation efforts particularly has uniquely positioned it within the market, particularly as it's connected to now digital exchanges. Love for you to talk, share with us what that process was like and in what ways has that now allowed, the bank to differentiate itself amongst its peer and unlocked opportunities.
I think that it was hard. We spent 10 years modernizing our backend technology. And as a company, we had done, this is a good story, I think, for others to think about. It's actually a very close parallel to what we've heard about AI and the AI adoption curve. And the steps that you have to go through to actually be able to get economic value out of a lot of the innovations that we've seen, because it's not overnight, right? Walt mentioned data very early on. To take advantage of both AI and stablecoins and digital assets, you have got to have clean data that you can trust and that you can access. So in our case, we had done over 100 acquisitions of other banks in our history. We had already consolidated that down to 8 primary brands. One of those is California Bank and Trust here in California. But we had never actually merged all of those. We offered different products. We had different systems that serviced those. Sometimes they were similar versions of the same system, but guess what? We used the data differently. That meant that bankers couldn't trust it. It meant that they were double checking things constantly. It meant that automation wouldn't actually work because we would be automating things that were inconsistent or simply inaccurate. In some cases, you think about lending, we had a big effort back in, well, I'll just say over the last 10 years to really digitize historical loan files. You'll see a lot of banks actually going back and having to sort of crack open, they'll call it open the loan files, to do work like pledging those or making them available on digital ledgers. So there's a lot of sort of foundational work that a bank will need to do just to make sure that the data is then accessible and then that you can integrate that data across all of your systems. So we went from 500 products that we sold just on the deposit side to about 80. That sounds like a lot, but you think about consumers, businesses, everything in between, all sorts of different rate structures. We standardize all of our operations. We went from over 20 different instances or versions of loan and deposit systems to a single one. And then that's allowed us to have now a single system, a single source of truth, and a single data model that we can then take advantage of, whether it's for AI or to use on this new set of infrastructure, this new payment rail that we'll think about as stablecoins and tokenized deposits, or to leverage for the combination of the two, which is where we see a lot of potential value.
I like that because what you've just highlighted to other firms, particularly regionals that are thinking of entering into the space, is that in addition to the initial outlay of the capital investment, the other risk may be just bringing the entire cultural team on, the leadership team and the banking team on buy-in, but also as well balancing the short-term those risks while also looking at short-term and long-term ROI that it could potentially unfold. And so with that, let's shift over to the topic of the risks, the gaps, the challenges that firms will navigate as they're thinking about their focus around their policies. And so, Walt, there's been a lot of discussion around, are stablecoins transparent? They move at blockchain speeds, whereas traditional finance has built-in friction. Reserve requirements can shift without the time for real-time disclosures. And so, given your extensive background and experience in helping to navigate financial firms in this space, I'd love for you to start to just walk us through the legislative and executive history that's taken place over the last few administrations that have been seminal to where we are today for firms that are thinking about entering into the space.
So under the first Trump administration, digital assets were really an unknown to many people. And I was fortunate to work with some people in that administration to create the first ever nationally chartered bank focused on crypto and digital assets. I brought them through a very extensive process. This is all public. It's Anchorage Digital Bank. We went through an extensive process to create a proper technology stack, proper AML system, to create global reach, because as I think we all know that stablecoins and digital assets are global in nature, right? They have a free-flowing nature, whether it be from Singapore, where I'm going next week, to to Dubai, whatever the case may be. So creating that sort of a platform really comes down to what I think of as people, processes, and technology. You need the right people, you need the right policies and procedures, and as I mentioned, that tech stack, which takes, frankly, a lot of engineers to build properly if you haven't already done so. So fast forward through the Biden administration, which let's just say took a very cautious approach to digital assets, to today, there was a presidential working group which came up with a series of recommendations. The Genius Act passed and became law. That was July 18th of this year. There will be an extensive process of creating regulations pursuant to the act. My understanding from the current regulators is they're making excellent progress in creating those regulations, but there are some real cornerstones to keep in mind as part of this regulatory process. In order to issue stablecoins, you need to be a PPSI, which is a permitted stablecoin issuer, which of course includes banks and other approved state or federal entities. And then I think this is very important. Reserves need to be in place on a one-to-one liquid basis, and the liquidity needs to be very, very high quality assets. The other two pieces that I think of that are cornerstones of the legislation are transparency. The CEO and the CFO need to certify as to the sufficiency of the institution's internal controls, essentially. And if you look back to March of 23, where we had some unfortunate rapid failures on the West Coast and other parts of the country, a lot of that comes down to governance, risk management, and internal controls. So that transparency and making that public, I think, is a major step forward. There's also some consumer provisions, but the AML and CFT provisions now apply 100% to stablecoin issuers. So you're talking about KYC, you're talking about SARS, you're talking about a full-fledged AML program. So those are some of the capstones I think about that need to be taken into consideration. But as I say, these things can be done. They can be built out properly. You just follow the proper methodology.
So what I took away from that, I think is important for all of us, is the importance of having sound systems in place and a risk management governance framework in addressing the emerging technology that one is integrating into their systems. Just drilling down a little bit more around doing a double tapping on the prudential security focus, particularly as it relates to AML and KYC. One of the common for lack of a better word, heartburn that I hear a lot of risk professionals share is that oftentimes, whenever there's an asset that is stable and is liquid, it's attractive, US dollar currency or another major country's currency that has those characteristics. It's no different for stablecoins. And so, as firms are actively considering navigating their role and their scope of responsibility and choosing whether or not to adopt and integrate these types of assets, how should they be thinking about, to your point, as you just talked about, balancing their compliance with their risk management framework and moving forward? And is there a role per se for technology to play to help with this?
Absolutely. And that's what we do in the project I mentioned and in several others. Really, when I think about this, I think about sustainability and resiliency of the company and its programs. I think about the fundamental risk profile of the institution. And I think this is very significant under the current administration. They're looking for a materiality concept that's applied to the types of activities that the bank undertakes or other type of financial institution. And the proper programs need to be tailored to the risk profile of the institution. So the things I think about are privacy, third-party risk management, asset volatility, cybersecurity, and AML CFT, as I mentioned a couple of minutes ago. Those are some of the capstones that need to be taken into account. But then back to technology, if you don't have it in place, all of this becomes almost impossible. And one of the things we created is something called the trust system that exists among stablecoin and other crypto players. And so think about the biggest players like Coinbase, Anchorage, and others that share information that's necessary to do proper KYC and to ensure the safety and soundness, not just of those institutions, but also of the system as a whole. And that's, I think, a big takeaway for bankers, because there's something called sections 314A and B that allow for the sharing of information among institutions, but it really hasn't happened very much. And I think that's a potential building block for people to take into consideration.
I wonder if it also helps unlock a new job market and economic opportunity.
Absolutely.
We need more cybersecurity and compliance folks, along with bankers. But Christiane, I wanted to pivot over to you. How about your perspective on this?
Well, I think about some of the roles that banks might play, because banks have been, you sort of alluded to this, Walt, but banks have been largely shut out of being able to play in the stablecoin space because of regulatory uncertainty. And so what they started doing was first experimenting with tokenized deposits. So taking real bank money and just representing it on a blockchain. And so some of the largest banks have been doing this for over 10 years. There's now over 1.5 trillion represented on blockchain networks being used to create value, particularly in a couple areas, but around sort of settlement and liquidity management. So think about the largest banks globally settling money internationally and moving money around for their own intraday settlement and liquidity needs. And then second, they started to do this for large institutional clients. And so creating a lot of value here because it's 24/7, it moves immediately. And they were doing this in what is called a private permissioned network. So these are sort of internal bank networks that they had regulatory clarity around because they couldn't do the stablecoin side of things, which would be over sort of a more public network. And then again, not using US dollars. Now, I don't want to say that tokenized deposits are any less good than stablecoins. I'm just saying that's where they played because that's where they had regulatory clarity. I think what we're going to start to see now is application of this more broadly within the regulated banking system as we get increased regulatory clarity around, so stablecoins in particular, really interesting and useful for international transactions. You know, I can do real-time payments already with legacy, quote unquote, legacy rails that were existing sort of outside the blockchain domestically, up to $10 million, and those settle pretty much instantaneously, but they don't work outside the US. So one is international transactions and cutting down sort of cross-border settlement timeframes. You've got interest rate risk that gets reduced, and counterparty risk that gets reduced as well by using stable coins for that. Domestically and internationally, I also think you're going to start to see where I see sort of probably the best value for banks and for companies is in applying this for what's called programmable payments. And you can do that whether it's a stable coin or a tokenized deposit. I'm going to actually program the payment itself because it's represented on this blockchain ledger with a series of conditions. And so as that money moves, I can also control for other factors. So delivery versus payment, for example, removes counterparty risk. I can disperse funds at the same time I'm receiving goods. I can do that in real time, which means as an institution, I've vastly reduced my reconciliation needs and some of the other settlement risks that come with those time delays. These are good funds that are moving, so I don't have a credit risk that's sort of embedded inside the payment transaction. I can then extend that more broadly and think about all sorts of series of payment flows. And so this is going to be banks helping their customers and going more deeply into their customers, particularly businesses, into their payment processes and their products to help move money around smart contracts that'll fulfill when certain conditions are met and take other actions. So I think that'll take us a while to get there because you need there's sort of a network effect that I know Ben knows a lot about that kind of needs to be built. Back to that theme of it's going to take us a while to get there. But I think that's where we probably see the most promise here is it's not just a payment, but it's the whole orchestration of a process that embeds the movement of money within it.
Ben, thank you, Christian. Ben, I'd like for you to add your thoughts as well to Christian's point, specifically because you've worked in different markets around Asia and that have different regulatory spheres and environments. So.
Yeah, no, I think this is all very interesting, and it's very interesting to hear Walter and Christian talk about it really from a regulated side, kind of approaching it, where I've, in the past decade, let's say, I'm actually approaching it from the crypto side, and I'll address that in just a bit. I think on the system side, I think it's very interesting to think about how these systems are developed. And as I mentioned, I'm approaching it from the crypto side. People have the blockchain technology has been available for over a decade. People are programming on it, smart contracts and so forth, similar to what Christian was talking about in terms of gated payments and so forth. All that has been available, and they've been available without the regulatory infrastructure in place. So people have actually been issuing stable coins and using them domestically and internationally before the regulatory environment. Now they're not being done in a traditional finance world. They're not being done within the banking system and so forth, but they're done on open blockchains, people trading with each other, people trading on centralized exchanges, decentralized platforms and so forth, and using, stable coins like USDC, like USDT as a way of settlement, being the other side of these transactions. And the way I think about that is almost similar to, I think there's a good example and a terrible example, and I'll give about both. The good example is in certain countries, the government itself doesn't print the currency. They actually expect some of the large banks to print it. I think in Hong Kong, HSBC prints notes, Standard Chartered prints notes. They're both the same notes of the same value, but they're printed by different banks. And you could take the note from one bank or the other bank and get it, and that's the positive good example. The terrible example is if you're at a major casino in Vegas and you get a chip from one casino, you show up at another casino, they'll honor that chip, and it's a similar discussion. You basically have non-government entities printing not the currency itself, but an equivalent receipt for that currency. I mean, in Hong Kong's case, it's actually the currency. So stablecoin kind of follows that concept. You have major organizations that say, look, I'm printing a token here, take the token. I've got that money behind to back that. Now, throughout history of crypto, there's always been an argument. Do they actually have that reserve? Do they not? Do you trust that? Do you not trust that? And, you have stablecoins trading at $1 generally, and you have periods of time where it depegs when people are concerned about the quality of the backing, and it goes up and down and so forth. So that is the, I guess, non-regulatory progression of the stablecoin world over the past decade. And I think we're now at a point where traditional finance is now looking at how do we incorporate this technology, because it is a very efficient, very good way of doing finance. But how do we do it so that it fits in the traditional rules with regards to AML, KYC, the compliance, the tracking and knowing people? Whereas from a crypto perspective, it's always been, the AML, KYC side has always been a bit light. Not necessarily for, reasons of people hiding, but there's just very generally, the system is designed to use wallets to connect. And that digital wallet, the connection between a digital wallet and the actual person is not something that you can lock down. If I just happen to hand my electronic wallet to somebody else, now that person owns it, and that ownership transfer is done. That's the end of it. So that is kind of, I think, the difference there from that perspective. So, to think about it from that way, I think we're now trying to fit that framework into the current, traditional framework. To take a step on the more international side, I think the US has good financial rails for all the things people complain about. I complain about the cost of actually using electronic payment versus writing a check, putting it in an envelope, put a stamp on it, put it in a mailbox, have a post person pick it up, go to the post office, to another post office, drop it off, and then somebody else opening that, either electronic deposit or bring that to the bank to deposit. that's cheaper than me pressing a button and doing electronic payment because it costs me like X% more. And that X%, if it's a large payment, is actually pretty significant. I will pull out my paycheck and write it, and the stamp is cheap. So it actually kind of makes no sense. But you know, that's kind of the fact that the traditional rails have already been built, and it's very, very cheap to use, and therefore the traditional rail is cheaper than a electronic payment, which is, you know, more efficient and ecologically friendly, but not, you know, but costs more because the guy that built the new framework needs to recover their costs. So I think those are kind of the things that we're trying to work through. But the US has a very good system. You've got payments, you've got Venmo, you've got Zelle, you've got PayPal, you've got all the tools on your phone, on your computer to do whatever you want. That's not necessarily the case internationally, and I mean that both from a general financial rails perspective in terms of convenience of use, banking services internationally, especially in developing countries, you know, they just don't have the banking rails. A lot of people don't have IDs. They're not born with IDs. The birth certificate idea doesn't exist. People are not getting driver's license to use as their ID, and not through fault of their own. It's just that infrastructure, it hasn't been built. Without that infrastructure, then there's no KYC. There's no KYC means, you know, they can't really have a banking system that plugs into the more advanced Western banking system. So they don't have the financial rails. On top of that, there are also certain countries that have imposed currency control, and there's a completely separate political discussion around whether, you know, that's a fair thing or unfair thing for the population there. And, you know, those countries typically face very high inflation. So for the citizens of those countries, that is a real, you know, a burden that they have to shoulder. So for those countries, a lot of the population have adopted stablecoins because it is a stable way to keep their assets and not suffer from inflation. They're able to use a wallet without needing to provide a driver's license or birth certificate, which they don't have. And they're able to do payments. They're able to buy, sell things, settle, trade with other countries. It is a open and fair platform for them all. Yes, they're taking the risk that the companies that are providing that currency may not have 100% backing of those tokens, but it's the best they've got. And it's convenient, it's fast, it's efficient. So that adoption has actually been driving a lot of the growth in stablecoins. That's actually one of the practical uses of blockchain. But a lot of people ask, well, what do people even use blockchain for? That's actually a practical use of blockchain internationally that has been, you know, very well adopted. We're seeing that through Asia, we're seeing that in Africa, we're seeing that in a lot of emerging markets areas.
Appreciate that, because if I just drilling down on two key points of what you just shared, not only has the regulatory fragmentation potentially created some arbitrage and opportunities, but also it's, you know, it sounds like it's democratizing access. And those are some key examples of ways that it's encouraging entrance into the financial systems globally. So we have a few more minutes left. I want to just shift over to one final question and then wrap it up. But looking forward from now up until, let's say, 2023, assuming we have regulatory clarity that continues to emerge, what are some of the trends that you're excited about, that you'd like to see, or that you know will unfold within the next few years? So Walter, I'll start with you and then work on down.
So first of all, in terms of international supervision of stablecoins and blockchain activities, there was a seminal law passed in the 1990s. It's the Foreign Bank Supervision Enhancement Act, and it followed the BCCI meltdown that some of us may recall. And basically what it sets up is a home-host relationship between a home country and all the other countries in which a bank may operate. So that precedent is in place, and I know for a fact that the regulators are looking to that as a guidepost, if you will. And if you look at the market structure of what's happening globally in terms of stablecoins, from a banking point of view, the GSIB banks, the very large US banks, for example, the very large banks from the UK and other parts of the world, they all observe this FIBCIA structure, if you will, which again, I think stablecoins can follow and other issuers can follow. Two more quick points. I think this is going to benefit regional banks in a significant way, because they will be able to do exactly what Christian was just mentioning. And California is, of course, populated by many large regional banks. So I think the potential economic effect for California is quite positive. The last thing I want to mention is the issue of fair access and debanking. Fair access and debanking was a real issue during the prior administration because digital asset crypto companies were not able to plug into banks. And that has since changed. And we have a completely new policy with respect to fair access for all businesses, as long as they're legal businesses and can pass KYC. And I think that's a big deal. And I also think that spills over and benefits the unbanked and the underbanked, the underserved, because I think you'll see less of a basis for impermissible discrimination.
Thank you. Christian?
I think there's so much promise here, but this is also a relatively new financial instrument as it moves into sort of the more mainstream, particularly in the US. And so I do think what we are going to see, I wouldn't say this is a hope, but a reality, is that the risks associated with just that newness and sort of the burn-in of a new financial technology and instrument are going to materialize in some ways. And I don't think we know how big they are, how big they're going to be, but I think it's possible that we'll see some stablecoin issuers fail, particularly those that are non-bank entities. There's historical precedent for that in the UK with e-money. While reserves are backed 1-to-1, the audits there are retroactive. They're lookbacks, right? They're not just in time. And if you see like nascent controls and you don't have a good control and risk framework around this, you could see commingling of the reserve funds with operational funds. That happened in the UK. And I think on average, where there were insolvencies, people recovered about 65% of the assets. There's other risks. Walt mentioned, sort of alluded to potentially supporting financial crimes and money laundering. And so watching for the hardening of those processes. And then there's sort of the other side. There's a lot of opportunity for banks, but the other side of this is if this drains deposits out of banks, right? If people start to use this not just as a payment vehicle, but as a store of value, this could drain deposits from banks and their balance sheets. And so what that means for all of us and why we should care is, community and regional banks in the US provide 2/3 of the financing for small businesses. Small businesses are the primary creators of new jobs, right? So there's this whole cycle here that if you take away capital, banks take in deposits, they turn that around, they lend it out. The less capital banks have to lend out, then you can see, less lending or more expensive lending happen. And then for the economists in the room, I'm sure they're thinking about, well, what's the impact on monetary policy? If you've got more money sitting in outside the sort of traditional view of money, right, and assets, then are you blunting some of the policy instruments that you have? So I think there's a lot of promise, but I also think we're going to see a lot of really interesting things sort of evolve here and potentially some hard lessons as those control and risk frameworks mature.
Thank you, Christian. Ben, final thoughts?
Yeah, so I'll add two things. And as a crypto person, I got to talk about bigger scale things. I think one of the things that Christian mentioned is, the risk of people using stablecoins just to hold assets. And if you take it at current scale or the US scale, that's an issue for regional banks who may not get that deposit to have that cash on hand. If we take it in a much bigger scale, I think stablecoin is actually going to be a risk for a lot of the emerging markets, because in the same vein, the emerging markets will not have their currency if everybody starts, using stablecoins denominated in US dollar. It's great for the US because everybody's now going to a US dollar standard in a much more efficient system. It reduces the reasons why you wouldn't use a US dollar for settlements. And that's actually driving to US dollar domination around the world. And that's generally a positive for the US. But for a lot of the smaller countries who already have a problem keeping their currency in check and having their financial control and keeping their inflation under control and their currency under control, they will completely lose control over their currency. And it then begs the question of whether they should have their own currency or not. And I know there are some smaller countries who have already given up and just said, our currency is pegged to the dollar, that's it. I mean, that is one way to solve it. They completely give up control of issuing their own currency and run it on that. So, so that is one potential scenario that's positive for the US, but not necessarily positive for the smaller, more emerging countries that have some currency challenges. The second thing I'll mention just more generally, as we are at UCLA and I'm kind of more addressing the students than anybody else, I think Yola mentioned a great thing, and we were talking about this before. This whole space is a new opportunity for everybody to look at, to focus on. As I teach my class, I get a lot of questions from students on, where does this lead to, right? Where is the economy going? Where are the opportunities for students, for people to explore this new space? And this, I think, is very exciting. And I keep telling them, and I've replaced my final exam actually with a final project where people sit around and think about what projects they can do in the crypto space, in the blockchain space. And I've seen, great ideas, and every year the quality of the ideas have actually been improving. So, it's very exciting. But my point is simply that I think traditional finance, a lot of different business models and ideas have been tried and been done. But in crypto space, everything is greenfield, right? Everything is, available for you to go try and do different things. What if we put this system on the blockchain? What if we put that on the blockchain? What if we use blockchain to improve payments, improve storage, improve trading, improve anything finance oriented? And from that perspective, it's extremely exciting. So that's part of why I've been involved in the space for the past decade, and I'm quite excited by it. So
thank you, Ben. I'm excited as well for all of us. I'll just wrap it up with one final point here. JP Morgan's Asset and Wealth Management 2026 Outlook Promise, as well as Pressure, was recently released. It talks a lot about quite the opportunities as well as the risks, particularly around AI, and is a wonderful complement to the discussion that was had today by all of our esteemed guests and keynote speakers and panelists. And I would also encourage our audience, both here and virtually, to also read Chairman Semblis' piece on the Eye on the Market, specifically our firm's view on the private investment and alternative space. There was an earlier question by one of the audience members around some of the risks that we're seeing, but also the opportunities within that sphere. I think it's a wonderful deep dive, very balanced and nuanced perspective on that. So with that, please thank our panelists for their time and expertise. Really, thank you.
Yeah. What would you like to say?
Middle?
Sure.
No, yeah. If I can get out of this without knocking that bottle over, it'll be a miracle.
That will be the final exam. So our keynote today is John Hockey, and he's managing partner of Leonard Green Partners. And John has been leading in private equity investment. And Leonard Green and Partners, based here in Los Angeles, they have one office. They manage $25 billion in committed capital, and the firm partners with experienced management teams and often with founders to invest in market-leading companies. John joined Leonard Green and Partners in 1995. Previously was managing director in the Los Angeles office of Donaldson, Lufkin, and Jenrette, and prior was vice president in corporate finance for Drexel Burnham Lambert. He presently serves on the board of directors of a whole host of companies. So that's in your bio if you want to see, in your packet for his bio if you want to see those companies. He's a graduate of our sister institution, UC Berkeley, and has an MBA from Harvard Business School, and was named Buyout Pro of the Year for buyouts in 2002.
That's a long time ago.
It seems impossible, but yes. So to get started, because we're going to talk a lot about private equity, but why don't you tell us some more about what you do and what your firm does, kind of to set the stage.
Sure, happy to do it. And first off, it's a real honor to be here. I wonder why I got invited. I guess Warren Buffett was busy. But no, I'm very fortunate to have been, as you said, the product of the UC education system. I was born and raised in Oakland, California, went to Skyline High School, went to Cal after that, graduated from Cal, and got into the finance business in 1980. So thinking back to 1980, we had a 15% long bond, we had a prime rate of 21%, and we had an economy that is worse than anything anybody here could imagine. I got into finance working for Bank of America, and I saw this sort of wonderful little startup. It was Drexel Burnham Lambert, and I loved Drexel because what they were at the forefront of was basically democratizing capital. So they essentially financed entrepreneurs who did everything from created the gaming industry, certainly the cable industry, a lot of entertainment and those sorts of things. I did that for basically was a banker for a decade, and most of my clients were private equity firms. And I thought after a decade, I thought it was something I could do, so I came over and joined Leonard Green and Partners in 1995. I was fortunate in that I joined a good friend and a partner, John Sokoloff, also a Los Angeles resident. And at that point, we had a $200 million fund. As you mentioned, I don't know if the number is 25 billion of committed capital, but actually our AUM today is $75 billion. So we are the largest single office private equity firm in the world. We'll talk a little bit about that to the degree we want to explore that. But today we manage money for probably half of the states, several foreign countries. We own a portfolio is over 60 companies, which collectively do over $100 billion in revenues and employ 450,000 people. So it's a big business. It's an important business. What else to be said? I guess I'll talk just a little bit about our strategy, and then we can sort of have a dialogue here. But the interesting thing about private equity is it's sort of viewed, certainly in the press, as a monolith. I was actually up at Stanford, the enemy, yesterday, chatting with some kids. And before me, there was a professor, and he was sort of putting up, here's the leverage buyout business, or the PE business, and so they buy these old companies that are undermanaged, that have lots of cash flow, and they cut costs and basically save their way to success. And that's sort of a common view. Interestingly, we are always the bad guys in the movies. If it's not a hedge fund guy, it's a PE guy. We are the sneaky folks that are going to buy a business and tear it up and somehow make money doing that. There's a little bit of that in our industry, but I think one of the things I'd like to dispel is that PE is a monolith. It isn't a monolith. There are people who buy small things and grow them. There's people who buy sick things that fix them. There's people who buy middle-sized things. And then there's sort of our strategy. And what our strategy is pretty simple. We buy the market leaders. So we'll buy the best company in its industry. We will look for a great industry, and we'll look for a strong management team. And our advantage relative to other forms of capital, and particularly the public markets, is we can take a longer point of view. So public markets, notwithstanding everything, basically you're managing quarter to quarter, you're graded quarter to quarter. We aren't. And that gives us a chance to do things that might be more difficult in terms of investing in the business, in terms of changing out management teams, those sorts of things. It's not something we want to do. But just to sort of, back up and put it into basics, for when Leonard Green gets involved in a business, basically the company has had a track record that's kind of like this. And for us to make an investment, we have to have conviction. It won't do that. We have to have an expectation that it does that. We have to have some reasonable hope it'll do that. And as long as we're right on that, we're going to do just fine. People in our business are into multiples and those sorts of things. We don't really buy things at the wrong multiple as long as it does that. What it means is we just bought it a little bit early. And maybe if we bought it a year early, we're a little disappointed with our return. But at the end of the day, we've made our partners money. Over the 36 years we've been in business, we've returned net of fees over 20% compounded annually for 36 years. And that's why we are sought after as a partner of choice. We conduct ourselves with a modicum of humility. Probably very few people in this room are aware of my name, and there's a reason for that. We try to stay under the radar screen. You won't find us owning sports teams. You won't find us trying to change the world. All we're trying to do is manage the money for our clients in a sensible way.
Thank you. And I do remember from your website, it said 75 billion, but your bio says 25.
That's probably a function of our one-man IT department.
Right. So we had a question earlier, and I know that you all don't engage in this, but maybe you can opine on it. And it was about private equity and the fact that, private firms don't have as much exposure. There's some opacity, but private equity and the potential risk associated with the frothy valuations in AI and investment in AI. Do you have any kind of thoughts about what private equity in general is doing in that regard?
Yeah, private equity would be an interested observer from the sidelines for the most part.
Okay.
To a certain degree, folks in our industry and again, PE is not a monolith, and there's sort of, we would be, in fact, it was mentioned earlier, we would be called alternatives. And just to give you a sense of scale, I think that public markets today are worth about, US about 70 trillion. And the entire PE world is about 5 trillion. So that'll give you, and then if you throw in other alternatives, well, maybe 10% of value out there. But in any event, as it relates to AI, there's dabbling in what I'll call the picks and shovels part of AI. So building data centers, helping with some investing in power generation. We're looking at a business right now that basically provides the hangers, the rods and such that the conduit and such is stretched over. So it's sort of AI adjacent. And then beyond that, we're all looking at how AI, what it might do for our companies and what it might do to our companies. So to give you an example, we have an investment company called Insight Global. Insight Global does a great business. What they do is they do temporary staffing. They used to do help desk. Well, the help desk business is not a good business. What are they doing now? They're doing temporary staffing as it relates for firms that basically train AI agents. So while folks like Amazon are laying off tens of thousands of people because of efficiencies in AI and because of their need to deploy capital in AI, they are hiring thousands of our employees to basically make sure that their agents are up to snuff.
And so you talked about creating value, and I wonder if you can kind of go a little deeper into that and in the way in which you create value and kind of how that feeds into the broader economy and economic growth in the local community or in the nation.
Yeah, it's a somewhat fraught subject for our industry. What I used to like to say was if we were creating value, it means we made a mistake in the investment, which was a little glib. But look at being able to take a longer view allows you to sort of do things with longer time horizons. So how do we create value? We create value in our engagement with our employees, for example. So we are founding members of an organization called Ownership Works. What Ownership Works does is it is promulgating best practices as it relates to broad employee ownership of the businesses PE invests in. And we're doing it because in part, for not terribly noble reasons, PR, looks good. But beyond that, what we found as investors is that employees who have a stake in the game do better. So in the last 5 years, we've distributed $35 billion back to our limited partners. At the same time, we've distributed over $10 billion to the employees of the companies that we have investments in. And I can tell you wonderful stories. We own a company called SRS. There's a fellow by the name of Dwayne White, I think his name, worked in our Seattle branch. Dwayne had worked behind a desk. The front desk never made more than $18 an hour. He's 65 years old. He retired with $3 million after this transaction. And being involved in that is, it feels great, but let's talk about the important things for our LPs. The companies that treat their employees this way, employee turnover is a third. Employee satisfaction is 3x what it is at other companies. Employee engagement is better. Safety factors are better. Productivity is better. So it's in many respects a free lunch to make people partners. So that's one way we add value. As a firm, we basically, with 60 different companies, there's somebody doing things wrong at every company, and there's somebody doing things right at every company. And so what we'll do is we do what we can to promulgate best practices by essentially sort of getting together people with similar interests, real estate, insurance, shipping, IT, security, whatever it is, and making sure that the right people are doing the right things on a consistent basis among the $100 billion of revenue businesses we own. So those are some of the ways.
So I know that you're both chief economist and chief investment officer, and both in the short term and in the long term, you have to do forecasting. We've talked a lot at this conference, in our forecast section, especially about forecasting with limited data or forecasting in a fog. Can you relate, some of your experiences in forecasting and what was successful and not? And also, what are you doing today with this dearth of data that we have?
Yeah, that's a great question. What's fascinating to me is with the amount of money and the number of really smart people examining the statistics, how wrong we get it. It absolutely blows my mind. And you're being generous when you're saying I'm sort of chief investment officer, because everybody's chief investment officer at a firm. I won't go through how we make our decisions, but everybody's involved. And I'm sort of chief economist because nobody else wants to do it. So I get to think about this stuff. But just to give you an example, and what I would, so when I went to Berkeley, all the cool kids had been there a couple of years before I got there. They'd gotten tear gas. They'd had the National Guard with bayonets. They had helicopters. Okay, when I got there,
good old days.
The good old days. When I got there, I got there in 1974. It took me 6 years to get to college, but that's a whole other story. But in any event, so our protesters, we wore badges that said "Question Authority." That was about as radical as we got. And so I've just kept that theory. And I brought some examples. I'm not going to pull them out. I don't think they're great, but what's fascinating is how wrong the government gets it with how many resources are available to it. And I'm going to come back to, so what do we think is going on? But the problem is that conventional economics, in my mind, lacks empathy. And empathy is an interesting word because we think of empathy as feelings. We think about it as sympathy, the ability to sort of feel other people's pain. That is a definition of empathy. But what empathy really is understanding the motivations of people. So I'll just give you an example where we got it wrong and the world got it right, or where we got it right and the world got it wrong. COVID happens, people are at home, And people are frightened and the economy is a mess and the government starts spending money. And the government threw at COVID about $4 trillion. They had paycheck protection, stuff like that. And what I thought was really interesting, so we sort of things go down and people thought they were going to stay down. We said they're going to come back. And here's the reason they're going to come back. You look at the lived life of the man on the street. We actually, in 2020 or 2021, we basically took a couple. She worked at a Walmart. He worked at an Amazon fulfillment center. They each made $15 an hour. What was their life like? And then what was their life like once COVID hit? And the answer was, once COVID hit, they who had been living paycheck to paycheck, all of a sudden, money starts coming in, good, and there's nothing to spend it on. So all of a sudden, those who live paycheck to paycheck had savings. And if you looked at the average savings for that couple living in Columbus, Ohio, all of a sudden they had $6,000 that they never had before. And they had dreams. They had dreams of cars, they had dreams of houses, they had dreams of this sort of life that they never could have imagined. And so what were they going to do? What they were going to do is they were going to live those dreams, which meant spending money. And you saw demand for cars go up. Anyway, it would all get recycled back into the world. So what happened? So what was fascinating sort of since COVID, the cash savings of Americans sort of pre-COVID was about $11 trillion. Sort of at the height, it was up to $15 trillion. And then over the last several years, basically that's been eaten down. So what does that mean to that person? Well, I had these dreams and I had this money, and then all of a sudden stuff got more expensive and I had to go back to work and I'm not getting paycheck protection. And all of a sudden my $6,000 is gone and I'm furious about it. So what does that mean? That means I'm going to elect new people because I'm mad about it. That means I'm going to be more irritated about things. That means we're going to have a more fractious environment, which is what we're going to see right now. And so you sort of look at things, and what was fascinating to me about just looking at the Fed and the choice and projections as it relates to inflation, they got that all wrong. As it related to GDP growth, they got all that stuff wrong. We got it right. We got it. I mean, just nailed it. I remember they were talking about 4.5% growth. We said it would be 9.5%. It was 10% growth, was what it ended up at. So kind of come back to where I started. Question authority. Just because the government says it doesn't mean it's right. Just because we lost 1/4 of information doesn't really mean much. There's all sorts of other ways to look at stuff. You can look at credit card data. You can look at shopping patterns. There's all kinds of different things. And so, again, the luxury of my business, I get to think about these things and sort of say, okay, where am I going to place my bets? I don't know if that's completely responsive to your question.
But let's go on with that. So you said, yeah. So where are you going to place your bets? So as you think about the U.S. economy and the various sectors and the potential places that one might invest in, are there sectors that you're favorable towards that you think are going to be growth sectors, and others that maybe are falling by the wayside?
Sure. And, what I would say is our approach is less strategic, which is sort of implied by your question, and more reactive.
Okay.
So we will come across a company, often it's owned by another private equity firm, and then we will try to assess what the outlook is for it. And there's certain businesses we would stay away from. So for example, I mentioned Insight Global. Right now, we wouldn't invest in an investment staffing business, in a temporary staffing business, because notwithstanding the great stuff and the great numbers that company is turning out, there's a risk factor that I don't think I can really assess correctly. So we made our bet, and that's the disadvantage for our business. We don't have the ability to just sort of dump the stock and move on to the next one. We did buy the great company with a great management team that is flourishing, doing much better than anybody else. But that's a thing I'd stay away from. Then I mentioned a company that I'm just looking at. So this is a company that basically does the hangars that the conduits are done for all these new data centers. Well, that sounds like a pretty good business right now. So just sort of reacting to that. You know, I'll give you, again, I don't know if a day in the life is interesting, but we had a company come in, this was 3 or 4 years ago, a company called RB Media. And what RB Media does is they do audiobooks. Okay, demand for audiobooks is going up. This company had it was a leader by far. They had locked in contracts with Spotify and with Amazon. They guaranteed the next 3 years of earnings and sound like a decent business. We go see the way they produce an audiobook is they hire actors and they have sound stages, and these actors, you know, basically read the books. And you're sort of looking forward, you say, well, that's okay, but, you know, wouldn't you like Morgan Freeman reading your book? Well, you know what? Morgan Freeman's going to be reading your book to you at some point. So we just sort of said, notwithstanding the fact that company's doing this and it's going to do that, beyond that, I don't know. It's probably going to do fine. But and then playing chess, 5 years from now, when it's time for us to sell it, what's the outlook going to be? And it's going to be cloudy. So a lot of people in our business would say, you know what? I like it at price X. It's like, no, there's a risk we can't assess. So we're not going to buy that business. So that doesn't really answer your question. Other than to say 35 years of experience, making mistakes, learning from those mistakes, sort of teach us to answer the 2 questions that we ask for any investment. We ask our people, 1, defend the proposition we won't lose money. Tell us why we won't lose money. That's a weird question, right? Weirdly phrased question. The most important thing we do is not lose people money. And the second is qualitatively, not quantitatively, tell me why we are convinced that we will make money. And if we can't answer those to beyond a reasonable doubt, there's always a reasonable doubt, but to a high degree, we just go invest in someplace else, because there's thousands of companies. As I said, it's a $5 trillion industry. We're a big company at $75 billion, but amongst the $5 trillion sandbox, there's lots of different things for us to do.
So amongst the kind of the $5 trillion private equity sector of finance, what percentage do you think is investing in the way that you invest, which is invest in whole developed companies and so on, and what percentage are doing other things like short-term investments to flip companies, et cetera?
Well, nobody's really investing short-term. I would say, and I can't answer the answer that I don't know. What I will say is that most companies in our industry believe in a value-added proposition. So they will go in their marketing, and you've talked with these folks. They'll basically say, okay, we're going to here's our management team. We'll bring them in, and they're going to help us, you know, run your business better. We don't believe in that model. We believe some firms that are great at it. You know, some come to mind, but generally speaking, what it does is it muddies up the decision making. So I'm a finance guy. I've got this operator sitting next to me. He's going to tell me about the pipe hanger business, and he can make it better. Who am I to say he's wrong? I don't know. So what happens is the responsibility for this investment I'm going to take his numbers, and the responsibility gets messed up. What happens is you sort of end up paying for what's done. So it's not that we don't believe in the model. It's just, you know, I'd say most people try to do it. Relatively few do it well. A lot of people talk about it. They talk about their 100-day plans. You know, we have a 100-day plan. When we buy a business, we listen. And then after that, for the next 100 days, we listen. And about a year later, we understand exactly what it is we own. And we're always surprised after doing it all these many years. 1 year later, this isn't what we thought it was, yay, or this isn't what we thought it was, But but it's never quite what you think it is.
Yeah.
And so, you know, again, that's just experience.
So we have a little time for questions, maybe one or two questions. And Thomas.
So we advise companies, well, thank you. We advise companies coming in, especially coming into the US from Europe, and they think they know a lot of stuff because they've done things elsewhere. And of course, it's completely different. We like to tell people that the present is the future that you didn't see coming. And you said one really interesting thing. You had 36 years of experience, or your firm has. But I wonder, I'd love to know more about how you are not hamstrung by your 36 years of experience and in looking at the future. And of course, there are wonderful stories about people who are investing who've missed WhatsApp and Airbnb and others that have gone on to be massively successful companies, and very experienced investors have said, we don't think that anyone is ever going to sleep on a sofa in somebody else's house. I mean, come on, who would even do that? So what lens do you use? What language do you use? How do you think about the future without being hamstrung by your 36 years of experience?
It's a wonderful question. And again, it kind of comes down to humility. Look, we understand the business proposition. We just don't think we're the right people to evaluate it. So my son-in-law, for example, he's a partner at Sequoia Ventures. Okay, they do this stuff all the time. They do it better than anybody. You know, he's got his Klarna IPO and his Figma IPO and this IPO and the other stuff going, and it's just kind of like, that's not my business. And, you know, I think it comes down to knowing what you're good at. We just bought a company called Top Golf. Okay, you guys are all familiar with that. I don't think it gets done in by AI. I'm just not that concerned about AI's impact on Top Golf. Now, Top Golf is a somewhat unusual business for us because it's not this company. It's this company that's just done this. And so we're betting that's sustainable. There's some reasons which I won't go into, but we paid 4.5 times cash flow for it. We think that if this continues, it's worth 8 times cash flow. So we'll get a multiple expansion on higher EBITDA. That's the bet for that. But we can tell you why we think we're not going to lose money. We can tell you why we think we're going to make money, and we'll see if we were right. So, you know, again, it's just small subset of the world. And, you know, again, I was sort of interested that I was invited to this event because, you know, I am, you know, I have a view on cyber currencies that would probably not be welcome in this room, which is that I think they're great because they're not currencies, though. It's not a store of value. We've seen what's happened the last couple of years. It's not really a medium of exchange. That's a currency. So if you called it cyber stuff, it probably, so there's interesting branding going on with it. But ultimately, what is it a bet on? It's a bet on the underground economy. And I think that's a pretty damn interesting bet. It's not what I'm going to make. I don't own any Bitcoin, but, you know, crime needs currency. That's great. And corrupt governments need workarounds. And so there's a use case for it. Anyway.
Yeah, so we have had a full conference on that.
Right.
So it would be welcome in this room. We have one last question? How about in the front?
I would love to ask. I'm actually Morgan. I'm a student over at UCI in the Master of Finance program. I was wanting to ask you regarding your ideology and PIN about always questioning authority.
Yeah.
What are the kinds of thought processes you go through and the questions that you're asking yourself and what you're looking into and maybe resources you look at when you're going through that process and trying to figure things out for yourself?
Well, I think that the most important thing is to understand what the conventional wisdom is and just sort of ask yourself, does that make sense? So there's a bubble around AI. There is enthusiasm around AI that I find fascinating today. You guys might have read there's an article in the Wall Street Journal yesterday about how the military enlisted people are making fortunes speculating on AI, the Magnificent Seven, and Bitcoin. Okay, when soldiers are making money on Bitcoin and look, time to really ask, is this sustainable or is this just a fad? So I guess the whole thing is we're being paid to make independent views and just understand that that's your job and approach it with curiosity, but also humility. And if something doesn't feel right, just stay away from it. You know, young people, if, you know, I've had, you know, I do a lot of stuff with young people. And there's this great enthusiasm around them. And, you know, I get one of my young people, this is the deal. It's like, no, it's not. There will always be another deal. This is not the one you have to do. So just, you know, just calm down, think things through slowly, and then sort of, you know, conduct yourself appropriately. That wasn't a great answer to your question. I'm gonna have to one question I can answer better than that one.
Okay, well, but that provides a nice segue because we do have students here and students online, our MBA students. And so to close it out, what advice would you give to an MBA student who's thinking about private equity as a potential career?
Okay, well, I love to do this, and I spend a lot of time with young people, both just to keep my mind fresh and know what they think about. But a couple of things. First off, I'm going to tell a story. So when I got out of Harvard Business School, and these are 900 of, you know, the brightest people I ever knew, a lot of them a lot smarter than me. The two biggest determinants of where they went to work were one, fashion, and two, prestige. And if you think about it, that has nothing to do with you. That has to do with what the other 900 people think of the choices you make, right? So the best guys from my business school class, the best, went to Trammell Crow. I don't know if you guys know Trammell Crow. It's a real estate developing business in Dallas. You go to Trammell Crow, they were bankrupt 5 years later. That was the prestigious and fashionable choice at the time. Or you go to Goldman Sachs, or you go to, you know, or you go to McKinsey. So consulting was a big one, McKinsey, or okay, that was it. Nothing to do with you, everything to do with everybody else thinks. There are four things that are important as it relates to career choices. Okay, what are you doing? Who are you doing it with? Where are you doing it? And what are you getting paid to do it? Those are the only four things that matter, right? So we'll come back to private equity in a bit. But if you can sort of get your head out of the noise that you all have because you're competitive people and you've got friends and you're trying to impress them and XYZ got this, there's a lot of FOMO and all the rest of that. You can get your head away from that and just say, what works for me? That will be your North Star and you're going to do great. So as to PE, PE is a business that I would say is, generally speaking, not a great place to start in. It's a great place to end up in. There's a reason why I was a banker for 10 years. And the reason why was I got a chance to see a deal a month for a decade. So I got to see different businesses and I got to see different investment styles. And I had lots of opportunities to work for my clients, one a year for sure, for a decade. I didn't go until I thought I was ready, till I thought I'd had a broad enough experience where I understood kind of the strategy that would work for me, not buying the crappy ones and fixing them, buying the good ones and riding them. And so that was kind of where I went. So if you want to get into PE, what I basically say is go to investment banking, get broader experience, and then from there, that's a good time to transfer over. And that's great. Now, at our firm's different, in my advertising, we have a way of providing breadth of experience because I'm very mindful of the experience we're giving young people. So it's a little bit different, but PE in general, most people that sort of join it, they kind of don't like it. It's not a great lifestyle early on. So certainly the big firms, smaller firms, you're going to find great people to team up with.
Great, that's a great answer. Please join me in thanking John for coming down here and sharing his experiences. John, thank you. That was great.
Thank you.
Okay, and just a final announcement before you go. And that is, once again, we have sponsors and we could not put on these events without our sponsors. So I would like to thank them again. And so our principal sponsors today are RSM and Yamava Resort and Casino at San Manuel. At the platinum level, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and University Credit Union. Gold level, Alaska Airlines, Bank of California, California Steel Industries, Hub International, Leap Development, PNC Bank, Robert Half, SMBC, Manu Bank. At the silver level, Marsh McClellan Agency, Salome, U.S. Bank Private Wealth Management, and Wilmington Trust. And at the bronze level, Accutive Security, Hanmi Bank, HDR, the Port of Long Beach, and JP Morgan. Coming up in March, first week of March, is our next conference. We also have our Orange County conference in April, so look forward to that. Next month, we'll be releasing the Allen Matkins UCLA Anderson Forecast California Commercial Real Estate Survey, so look for that coming out. And then in early March, the China-US Economic Relations Report. So lots of things coming up. We look forward to seeing you again.